the National Stock Exchange of India and Mumbai School of Economics and Public Policy, I warmly welcome you to our first joint conference on digital technologies and financial inclusion. We are delighted to have distinguished dignitaries, experts, and scholars join us today to explore how technology is reshaping India's financial landscape. Before we begin today's discussion, I request everyone to rise for the national anthem.
जन गण मन अधिनायक जय हे भारत भाग्य विधाता पंजाब सिंध गुजरात मराठा द्राविड उत्कल गंगा विंध्य हिमाचल यमुना गंगा उच्चल जलधि तरंगा तव शुभ नामे जागे तव शुभ आशीष मांगे गाहे तव जय गाथा जन गण मंगलदायक जय हे भारत भाग्य विधाता जय हे जय हे जय हे जय 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 हे
Thank you. We would begin today's event with the ceremonial lighting of the lamp. I invite our esteemed dignitaries on stage for lamp lighting ceremony and a group photograph. Professor S. Sudarshan, IIT Bombay, Dr. Tirthankar Patnaik, Chief Economist, NSE, Shri Shailesh Pathak, Senior Advisor, Policy and Media, NSE, and Professor Manisha Karne, Director of MSEPP.
वक्रतुण्ड महाकाय सूर्यकोटिः समप्रभ
वक्रतुण्ड महाकाय सूर्यकोटिः समप्रभ
निर्विघ्नं कुरु मे देव सर्वकार्येषु सर्वदा
निर्विघ्नं कुरु मे देव सर्वकार्येषु सर्वदा
वक्रतुण्ड महाकाय सूर्यकोटिः समप्रभ निर्विघ्नं कुरु मे देव सर्वकार्येषु सर्वदा.
Thank you. I now invite Shri Shailesh Pathak, Senior Advisory Policy and Media at NSE, to deliver the welcome address.
Namaskar and welcome to the National Stock Exchange, ladies and gentlemen, dignitaries on the dais. We have a special dignitary sitting right in front of me. His name is Mr. Vasudevan. Mr. Vasudevan, please raise your hands. Yeah. And Mr. Vasudevan retired from the Reserve Bank of India 25 years ago. So in the year 2000, right? And I was asking him And I was asking Professor Sudarshan that in the year 2000, and I'm asking all of you, some of you were slightly young in 2000, but I'm asking all of you, in the year 2000, did you know that UPI was going to happen in India? Yes or no? No. Think of it. When did you hear of UPI the first time? Most people heard of UPI for the first time in 2014-15. So, all these young people in the audience at the back, in 2047, when India turns 100, do we really know what's going to happen? That is how many years to go? Effectively, how many years? 22 years. We are in 2025 to 2047. Who knows what's going to happen? But one thing is for sure. The topic that we are discussing today will be one of the biggest drivers of India's progress going forward. I'm going to tell you a story here. The G20 group of nations has a Business 20, B20. And I've been part of that B20 since 2016, 2016. So in 2016, madam, we had our meetings in Hangzhou in China. And what happens is you land at Shanghai and you take the high-speed rail to Hangzhou, and then you attend the B20 meetings and you come back by high-speed rail to Shanghai. So I said, let me spend a day doing a tour of Shanghai. And we had around 10 people from 5 different countries. And there was this 24-year-old Chinese lady who was our tour guide. And of course, we went to Shenzhen and all those Shanghai landmarks. But I remember she said that I get up in the morning and I just take my phone and I don't need any cash. 2016, August. I come out, I have Alipay, I have Baidu, I have whatever on my phone, and I don't need any cash. I just need my mobile phone. On the way back from Shanghai to India, I was wondering to myself, August 2016, when will this happen in India? Those of you who remember, we had exactly 0 market share of mobile phone transactions in the world. Today, we have 48 to 50% market share. I think that calls for a round of applause. If I had asked someone in January 2016, will it happen by December 2025? People would have said, ille, vanda. So if I ask any of you right now, what's going to happen by 2035, who knows? But I see a whole lot of bright people here, and I see a whole lot of bright people here who are going to make similar successes happen. So this was the welcome remarks from the National Stock Exchange. A little bit of a plug because all of you are sitting in the National Stock Exchange. We have a very good economic policy research team. Dr. Tirthankar Patnaik heads it, and I would request all the EPR team people to raise your hand and wave like this. Just look around, yeah? So what these guys do over there, is they come out with a monthly market pulse. And that monthly market pulse is available online, free. Of course, I've been encouraging them to put some password protection so that we know how many people download it. Yeah? And there is a digest, which is easier to read. This is last month's, this is current month's. So you have the option of having a very thick volume, which someone has here. A thick volume. Yeah, that's the thick volume. Just wave it around. So, ye thoda bhari hai. It's also available on PDF and on digest. I would strongly encourage all of you to suggest to us on what kind of market economic research and analysis, our very bright team can do. I have a long speech, but I think this was the welcome to all of you. Thank you from NSE. Thank you.
Thank you, sir, for the encouraging words. I now request Dr. Manisha Karne to deliver her address.
Thank you, Shri Shailesh Pathak, for setting the tone of this conference. And a very good afternoon to everyone and very warm welcome to all of you. I think the welcome is already conveyed through good lunch that we all had and the atmosphere, which is absolutely amazing over here. Dignitaries on the dais, our Honorable Vice Chancellor, sir, is likely to arrive soon. The keynote speaker today, Professor Sudarshan. He is a professor in Bombay IIT, and Shri Shailesh Pathak, who set the tone just now, and Tirthankar Patnaik, Dr. Tirthankar Patnaik. I welcome all of you. I also extend a very warm welcome to our senior alumni member, Dr. Vasudevan is here, and my former directors of Economics Department, Professor Pethe, Professor Diwan, and also advisory members of Dave Center, all my faculty and NSE officials here, and all our dear students. Let me speak briefly about Dr. S.A. Dave Center in Finance, which is the main organizer along with NSE of this conference. Dr. S.A. Dave Center was a centenary gift given to the department in 2021. Dr. S.A. Dave, who is the senior alumnus of our department, who is also the former chairman of UTI and SEBI, on the occasion of centenary of the department in 2021, he gave the corpus of 5 crores to the department, with which this Dave Center of Finance was started. It is a big value addition for our students because being in Mumbai, which is the financial capital of India, we have now this center through which we can encourage research in finance. I wish Dave sir was around today with us in this auditorium. Since its inception, this center has been organizing various seminars for our students by experts in crucial areas such as financial markets, evolution of financial systems in India, financial markets and its linkages, machine learning and its application to firm finance, and high-frequency trading, retail revolution in financial markets, and for personal finance. Recently, this center has signed an MOU with Bankers Institute of Rural Development, Lucknow, to provide a certificate course in climate finance, which is another very important area. The vision of the center is to equip our students with cutting-edge skills so that they are able to take research in this area, and also which is something very important in the contemporary times. Another achievement is having this collaboration with NSE that indicates our active engagement with industry. Large number of our students from our department and various colleges across Mumbai are here. I'm sure they'll benefit from deliberation in today's conference. Thank you so much.
Thank you, Man. Dr. Ravindra Kulkarni, he would be joining us in some time. We will now move on to the keynote speech. Our keynote speaker today is Professor S. Sudarshan. He's professor at IIT Bombay. He's a leading computer scientist with extensive contributions to database systems. After early work at AT&T Bell Labs, he joined IIT Bombay, where he has built influential software systems and co-authored the globally acclaimed textbook, Database Systems Concepts. His research in query optimization and data search is widely cited, earning major international awards. A highly respected figure in the field, he has served on global editorial boards and advisory committees. He has received several prestigious industry and research honors for his impact on data management and computing. Professor S. Sudarshan also serves as the Public Interest Director on the NSE board. I now invite Sir to please deliver his keynote speech. Thank you.
Thank you, and welcome everyone. I hope you have a very exciting afternoon today. A lot of interesting panels coming up. But before you get into what is happening today, which is what the panels are about, and what is happening tomorrow, it's useful to look at what happened yesterday. So let me start off with yesterday, and that will help us understand why we are here today. Of course, the theme of this session is financial inclusion. But what is financial inclusion? I think all of you probably know this. There's a lot of things which come under the broader umbrella of finance. NSE, of course, is focusing on the stock market. But there's also banking, there is insurance, and there are many, many more things which are in the broader scope of finance. And finance is what drives every economy. Without it, we would be nowhere. India has developed tremendously over the past several decades. Of course, ever since independence, it has been a continuous path, with sometimes faster, sometimes slower, but it has always been upward. And this is continuing today, and India is rising, that is clear. But what is also important is that every Indian also rise with it. A rising tide should raise all ships. It shouldn't let some sink underneath. So part of what this theme is about is the inclusion part, which is how do we reach out and how do we make sure that the poorest Indians also benefit from the rising tide. So first, let's look at the past, as I told you. What was happening before the whole digital era started in India? If you see on the top right there, you will see our competitor, BSE, back then. You had the open cry system. You had all these people yelling out orders, and trades are noted on little slips of paper. It is amazing that the system worked. It did work as much as it did, but this was not optimal, right? So what was wrong with it? There were many things wrong with it. First of all, there was fraud of all types which was enabled by a system where there were very few controls. For example, your broker might have bought a stock at the low price of the day and will tell you he bought it at the high price of the day and pocket the difference. Right? You don't know what is happening. Brokers would take your money and gamble with it, and maybe you'll never get it back. Nobody knows what is happening. There were, of course, other kinds of fraud, Harshad Mehta, the Big Bull, and so on. And then there were frauds of all types with documents, including shared certificates, land deeds, and so on. So to me, by the way, of course, frauds increased over time. Financial systems have been around for a long time. We think that they are new, but the reason why Venice back then, or Europe and Britain in particular, grew and could dominate us is because of their financial systems, which allowed cooperation. People could pool their money and take shared risks and build things. That's the foundation of capitalism. It's the foundation of the East India Company, which came and took us over. But the point is that the financial part of it underlies the cooperation. And if we cooperate, we can achieve things. And the finance part is critical, but if you have fraud, there goes cooperation. So trust is the key to any nation's growth. And I want to talk a little bit about how the digital revolution has played a big role in improving trust, to the point today that we are way, way better than we were a while back. So where did our digital revolution start? Right? In the 1990s, I would say, a little bit in the 80s, but a lot of steam picked up in the 1990s. Banks were computerized. Unions opposed it, but it was clearly the wave of the future, and it happened. Took some time, there were delays, but it happened. and we all benefit from it today. One of the very first fully digital stock exchanges in the world was set up in India. And I would claim that it was probably the first fintech company because it's all about tech for finance. And I guess you know which company this was. Anyone wants to speak up? Yes, of course, it's NSE, right? It was set up in the 1994, started operation a little bit later, in response to scams, right? People realized the need for transparency, and there were some extremely visionary people who figured out that this is the right way to go forward. And at that time, BSE was the big boss. NSE was a tiny startup with a few people. But today, it is dominating the place, simply because it brought in transparency, and people trusted it. Similarly, there's a lot more aspects to the digitalization. Share certificates were being duplicated and sold, so you didn't know when you bought a thing, is it real? It might bounce back after you've given away the money. So DMAT was another big revolution which was introduced. And that has brought trust, right? If you give your money, you know you're getting a genuine share in a company. You don't worry whether you have been defrauded. So there's complete transparency which this brought in. And I would say this is the first leap. So now it enabled people to trust again. Long back there was trust when systems were smaller, fewer people were there. But anything which becomes big, there are also issues with trust. So it started coming back. Then there was the second generation of digitalization in India, which again, you are familiar with most of these, but I'm going to talk first about the stuff that happened in the 2000s. What India realized is that we need ID cards. We need to authenticate people. We were already around almost 1 billion then. We are, of course, quite a bit more now. But how do we know who is who? When you have a sea of faces, how do we make sure we are transacting with the right person? And Aadhaar was a tremendous vision that we could do this at a scale of 1 billion people. And the way it was done was also amazing, how small teams of people at extremely low cost could generate an ID system for the whole of India. Of course, there were people who criticized it and say, what about privacy and so on. But the reality is, you need this sort of a thing. And that laid the foundations for the next generation of growth today. Without it, you don't know who you're transacting with. With it, you do. Okay, so that was the next major thing. Then, I was talking about frauds in the stock market and so on. Surveillance systems started getting built. Back in the 90s, along with NSE, the SEBI, which you all know about, was also created at that time. That was the other part of how to bring trust back into the system. And SEBI has done extremely well also. And there's a lot of things, systems set up to catch people who are trying to defraud you. Of course, that doesn't mean people will not keep trying. We have had recent scams which you're all aware of. Jane Street, for example. So these things will happen. But the important thing is that every new thing which happens will happen, but then you catch it and you restore trust in the system. So the other part which happened in the 2000s was the explosive growth of the web. All of us started booking our plane tickets online. That was one of the early things. Credit cards started becoming available, and web-based payments through credit cards happened. So this phase basically meant that people who are relatively well off started benefiting from the fintech revolution. And you and I, those of you who are here, are for the most part from this category, and we started benefiting. So this was the second great leap in trust, that now we could build scalable systems which, where you can trust that if someone is making the payment, they are actually going to pay the credit card company. How does the credit card company know that when I get a card, I will actually repay them? There's a whole bunch of technology that has gone into it, machine learning and so on, to categorize the risk and give me a card if they figure out that I will pay it, or ideally, if I don't pay it in full, I will keep paying them interest every month. That's our ideal customer. I'm not a good customer because I don't pay them interest. But the point is that they don't want a customer who will make the transaction and run away. So again, trust. Then let's move on to the next decade, 2010s. What happened, right? And as Mr. Pathak said, there was the UPI. But where did UPI come from? This came from the concept which Mr. Nandan Nilekani and his team, they first built Aadhaar, and they said, what next? And they introduced this concept of a digital public good. Now, there were payment systems. You could have digital wallets. You pay money to a company, and then you use the app to make some payment. But the problem is your money is stuck with that company. It doesn't interoperate with anybody else. And around the world, these sort of things had already been done, but they were limiting. Because you have 10 people apps, you have to have the merchant accept any one of the 10, it may not match the one you have, and it was not good. So the concept behind it is that there would be a common thing here, which will intermediate between any one on the payment side, any bank you're making the payment from, and any bank on the other side. You're familiar with this today. It's obvious, but it was not so obvious back then. And it was great that somebody decided that this is something we need as a nation. And this is a bunch of volunteers, right? It was not a government organization which did it, but a bunch of volunteers who put in their time and brains, more important, and came up with this architecture. And that's how UPI was born. Of course, it's not just an idea. You need an organization to build it. NPCI helped to build it. But it starts with an idea. And I hope many of you will have ideas which will start the next several generations of whatever it is we will be seeing in future. And coming back to Aadhaar, now when you want to get a mobile phone or you want to replace the SIM card on your phone, if somebody else could pretend to be you, well, they can steal all your money, right? That's how we are today. Without Aadhaar, there would be no way to actually give you a replacement card even. So what started off for a different purpose today is serving the trust which allows us to use online banking without worrying about it. Okay, battery, not my battery, I hope. Not yours also, I hope. Okay, let's finish up quickly before the battery dies. So, sorry. Yeah. So the point is that at the scale of billions now, we have trust, and that is essential for digitally enabling the masses, digital empowerment. And these are things which we take for granted, but there are still many people in the country who don't have access to it. And how to get to them. So on the top right, you see this picture, quaint picture of old coins and notes. Well, today's notes will soon be a quaint picture, the way things are going. I don't know how many of you even use notes or coins anymore, but 10 years back to now, it's this amazing change. So along with that, what are the other kinds of things that have happened, right? We have automated loan approvals. How do you decide to give money to a person? What is the basis? There's a whole digital trail that we leave behind whenever we do things. We take money from the bank, we make payments, and that digital trail is enabling people to find out whether I am trustworthy and can be given a loan. Without this sort of ability to quickly give loans and so on, the financial system will be creaking along. And this is greasing the system and making it move much faster. And that's critical for the next generation. Of course, there are many more things which you're familiar with. I won't go into all of them. Online commerce, ride hailing, automated, insurance even, stock market. Everything has gone digital today. So we have digital empowerment of the masses, which is kind of the theme for it. But are we done? No, there's a lot more. But how far have we come? So this slide gives a bunch of statistics. I'll thank Dr. Titankar for the statistics here. But the kind of growth that we have had in UPI in just the last 4 years, this is 8.3. I think it's probably even more today. It's just mind-blowingly exploding. Digital payments in India, which, as we were discussing earlier, we've started from almost nothing to half of what is there in the world, and it's continuing to grow. And there are many, many more aspects to it. I won't get into all the details. So how did this happen? Who made it happen, right? First, technology. Without technology, none of it had happened. Without computers, without databases, without the web, and today without the mobile phone, none of it would have happened. But that's not alone enough. There's a lot more. Government policies and initiatives played a big role. As I already told you, SEBI and NSE for the stock markets, India technology stack for the whole UPI scenario, that made it happen. But then people are the ones who make it happen. We had Dr. R.H. Patil, whose photo you see on the left there, who was the founder of NSE. He had brought the concept and actually built the institution. It's amazing how much this has grown over the years. One man's or a few people's idea. Government played a role in it too. The government supported this and made it happen. So that is also critical. Then we had Mr. Nandan Nilekani and his gang of architects and I would say thinkers, visionaries, dreamers, who put together the other parts of the India stack, and many, many more. We can't name all of them. And the good thing in India is that the financial institutions have been quick to take this on. They didn't say that, look, we will do it after everybody else has done it, right? We have a nice competitive scenario where everybody is jumping onto technology very, very early. That's great. But unless people start using it, none of this will go anywhere. And the great other thing is that our nation is young. People are ready to try out new things, and indeed we have. And the kind of adoption we have had has been tremendous. But the adoption is also because it solves real problems. If you are doing something which doesn't benefit you day to day, you will not use these technologies. So the other part of what I would like you people to take away from this is, if you're going to build the next generation of things, technology is great. I'm a technologist. But unless you solve a real problem, you're not going to go anywhere. And so you have to put these two together, the right technology and the right thing done in the right way, and we look forward to revolutions which you create. So today there are these three pillars: the rising customer adoption, the government initiatives, and the ecosystem support. And this is the second part. Technology alone is not enough. Again, this is Dr. Tirthankar's slide. Technology alone is not enough. It needs institutions. And it's not just the big institutions like NSE and the bank, but this whole fintech startup ecosystem which has developed in India, which is actually driving many of these things. All our financial institutions have had a history of outsourcing some of the cutting edge work to fintech companies, startups, and benefiting from it. There's also a reputation built up for some of our companies for using the fintechs and then throwing them out, which is terrible. That's a disaster for our ecosystem. But luckily, most people have done the right things, most institutions, and so our fintech industry is thriving. So the number of fintech unicorns is 26 at Decacon. Also, the number of the government policies have helped create an account for every person or every adult almost in India. Strangely, for those who are in the teens, there is nothing. You can have an account, but there are very little things you can do with it. And UPI also doesn't really want our teens to spend our money. I think UPI is full of parents whose children are spending too much money. I don't know if you're familiar with this. The young people here would relate to this. The older people maybe not. But giving a UPI access to your kid who's not yet 18 is very, very difficult still today. So that's the next generation, which I hope will soon get UPI like the rest of us. Okay, so all this is great. The other part of the revolution is that people have been investing in the stock market. And of course, we are sitting here in the center of that. The SIPs that are flowing in have been reaching all-time high, I think every month almost. It just keeps growing. And I think this is important because when our economy grows, companies grow, the stock market grows, and unless our people have a stake in it, they're not going to grow with it. So it's very critical that more people get into it. But there's also a history of people not getting into it because they were afraid they will lose their money because somebody cheats them. And I think this is where the other aspect of trust comes, that you have the right products with the right risk and the trust that behind it, there are people who will do the right thing for you. And I think we are at a stage today where all the things have come together, which is leading to this tremendous explosion in growth. Of course, there's another reason for the growth, which is people gambling in options and derivatives, which is a crazy thing to be doing. SEBI has been telling people don't do it for a long time, but people are still doing it. Great for NSE, but even NSE is going around telling people don't do it unless you know what you're doing, right? But it is an important, essential thing, but it's not meant for small-time people who don't understand what they are getting into. So we have to be careful about that, but the growth has, the percentage of the Indian market cap, which is owned by Indians, has been steadily going up, which I think is great. Again, this is a slide on some of the technology which powers it. DMAT, of course, eKYC, which all of us use all the time. The amount of difficulty which was there before to open an account with a broker was so painful. But today it's so easy. All of us create multiple accounts and then don't use them, most of them perhaps. But the point is that it's frictionless. We have our zero fee, I'll put it in quotes, brokers, app first, who have brought it to the masses. We have had UPI for IPOs, which has solved another, by UPI I mean ASBA, where you block the money in your account. That's another tremendous initiative which has cleaned up the whole thing. So IPOs today, I don't know how we are sitting here. Every day, every time I come to NSE, I have to come in through the side route because an IPO is happening here. So somehow they picked a day without an IPO, which is a very hard day to find. One happened today morning. Lenskart. Oh, okay. Lenskart. I think all of us have heard of Lenskart. So in fact, it's not just an IPO a day, it's 2 IPOs a day, one in the morning, one in the afternoon. So that's fantastic. A lot of companies are getting in and building stuff for us. So we are in a great place, but there are some challenges which we need to address today. In addition, there is what is the future? The whole AI thing is changing many things. How will it impact what we are doing? How will it impact the collaboration of people to build stuff, which is what finance enables? So these are all interesting questions. Nobody has the answer. You young people here will have to figure out these answers. Keep your minds open and figure it out. But the short-term sort of things which we see clear, immediate challenges is if you want financial inclusion, you must reach out to every Indian and with the right product. You don't want to sell them the wrong product, which is going to create unnecessary risks for them. By products, I don't mean just bank accounts. It's also the appropriate stock market related product, as well as insurance and other financial products, which people need badly. The number of farmers who go under and sadly even end their lives because they have tremendous risks. Can we use technology to de-risk this in a clean fashion? So that, if the crop fails, that doesn't mean they have lost their shirts. Something backs them up, right? So technology is actually already playing a role in this, but a lot more is needed to be able to price these things right and save people from the risks which they really should not be getting into. They should be insured against it. Digital fraud is on the rise. Everyone is aware of it. What can we do to prevent it is a major, major challenge. There are 2 kinds of levels. One is at the level of people hacking into system, ransomware, and other types of hacks which are happening on a day-to-day basis. And then there is the other side, which is people hacking into people's brains in some sense and making them give up OTPs and whatnot. And all of these need to be addressed. And there are a lot of important challenges. And at the margins, that is, what about the rural areas? What about people who don't know English? Most of our country doesn't know English. How do we reach out to them? And of course, things are happening. And I look forward to a lot more happening so that we have a rising tide. We need to make the tide rise, and we need to raise all of our Indians with it. With that, thank you.
Thank you, sir, for the very interesting presentation. I now request Dr. Ravindra Kulkarni to deliver his special address. Dr. Ravindra Kulkarni is an eminent academician, researcher, and administrator with over 3 decades of contribution to higher education. As Vice Chancellor of the University of Mumbai, he has championed innovation, digitization, and institutional strengthening. He has led major research projects, guided numerous scholars, published several peer-reviewed research papers, securing 3 patents. Renowned for his contributions, he has received prestigious awards like the UAA ICT Distinguished Alumnus Award and Professor J.G. Carney Memorial Award. I now request Sir to deliver his special address.
Dignitaries on the dais, Dr. Sudarshan ji, who provided great insights into the digital technologies and its role in financial inclusion. Dr. Shailesh Pathak, Tirthankar ji, our Mumbai School of Economics and Public Policy Director, Professor Manisha Karne, all the dignitaries who are present of the dais, and my dear fellow colleagues. It's a matter of really a pride for me to see that the Dave Center of Mumbai School of Economics and Public Policy is organizing a joint collaborative conference with National Stock Exchange, particularly on role of digital technologies in financial inclusion. We have just come across the phase-wise development and a dramatic mode of developments that have taken place through digital technologies since 1980s till currently. We have seen there has been a dramatic rise, particularly in digital transactions over last 10 years, and it is in fact getting multiple mode. Like in 2014, if you would look, okay, the digital transactions were probably, it was just a beginning. And within 5 years, the digital transactions increased almost by 10 times. And when we talk about digital magnitude of digital transactions in 2021, okay, so within 2 years, again, there has been a 10 times rise. So that shows the digital technologies have provided the financial inclusion to be made very much inclusive, affordable, accessible, and at comparatively lower cost. I will quote my own example, like whenever I used to take, say, for example, taxi in any other city. So in those days, like the taxi driver would be asking you whether are you carrying the right cash, so that I don't have to talk about returns and anything. So likewise, I was always being aware, keeping myself aware that whenever I'm supposed to travel by taxi, I'm supposed to keep cash well in hand, an exact amount. So after, say, on one particular day, I was just traveling by taxi, and I just have looked at the bill, and then the exact cash was prepared and say given to him. The taximan driver has politely refused. He says, "अब कैश कौन लेता है? आपके पास जीपे हो तो ही चलेगा. I won't accept cash." I said, "The cash is in exact amount. You don't have to bother." He said, "Why should I hold cash? You are paying me by GPay. The next moment, I would return whatever the loan I'm carrying for buying this vehicle. Next moment, I'm going to transfer part of the amount to that bank and part of the amount to my family, so that they can carry forward whatever the expenditure they are looking for." So this has been really a matter of great strength that has been brought by digital technologies in the life of common man, okay, including digital technologies for a like high technology mode. Of course, is one part, but going for financial inclusion and bringing lot of enhancements in the life space of common man is really a great path. And of course, while talking about digital technologies and its role in financial inclusion, from academics perspective also, I just would like to say that digital technologies have enabled many important roles in academics also. For example, just like the way Aadhaar card is talked about and its role in day-to-day life of a human being in multiple sectors. So similarly, like in last 2 to 3 years, for a student to take a particular number of credits, having an APAR ID, okay, has become an important part. And whatever he is learning, the pathways of credit transfer is occurring through an academic bank of credit. So that happens a really good moment for regular students and permitting taking up education from multiple institutions, mobility from one institution to another. So providing a great improvement in academic access. Online education has provided learning at any time, at any place and anywhere. Again, a really great sort of an inclusivity and accessibility coupled with academic excellence. And the third, probably which is likely to happen at any time, is a real-time delivery in the language which you would like to have. So that will make our teaching as well as learning completely language neutral and will provide the student the learning in a language in which they would like to have. So academics is also deriving a lot of benefits through these digital technologies. And I understand that this particular half-day workshop, which is carried by Mumbai School of Economics in collaboration with National Stock Exchange, NSE. Okay, I wish great success for this workshop. And I am sure through various deliberations, the participants would be able to have a lot of understanding in the development of digital technologies in financial inclusion. Thanks to all of you. Thank you.
Thank you, sir. We have now come to the end of the inaugural session. I now request Shri Shailesh Pathak to felicitate our chief guest, Dr. Ravindra Kulkarni. Yeah. So,
All right, so I want all of you to look back on the photo of that bull over there, which is what we just gave to the Honorable Vice Chancellor. There is a New York Stock Exchange bull also, and there's a National Stock Exchange bull also. The big difference is, एक तो bull Indian है, Indian breed. The bigger difference is, you see the people of India next to the bull. There is a young student, there is a farmer, there is a housewife, there is a woman professional. So, National Stock Exchange is all about financial inclusion, which is the topic today. Thank you.
so we also have a photograph, so a photo frame, which was clicked at the NSE Bull. I also request Shailesh sir to felicitate our keynote speaker, Professor S. Sudarshan. Thank you, sir. I now request Dr. Ravindra Kulkarni to felicitate our keynote speaker, Professor S. Sudarshan. And this is Dr. Ravindra Kulkarni to felicitate Shri Shailesh Pathak. I just request, just one more request, Shailesh sir, if you could felicitate Professor Manisha Karne. Or Tathankar sir. Thank you so much. I thank all the speakers of the inaugural session for their wonderful presentation and address. Thank you. We will now move to the panel discussion, the first panel discussion. The topic of the first panel discussion is payments revolution and beyond. India's digital payments ecosystem has transformed rapidly, powered by UPI, direct benefit transfers, and public digital infrastructure. Our first panel discussion will explore how India's digital public infrastructure has transformed payments and financial inclusion, its global relevance, and the extent to which digital access translates into real empowerment. Our panelists for the first session are Shri Ribhu Tyagi, Shri Shishir Mankar, Shri Sujay Vasudevan, and the discussion will be moderated by Dr. Niranjan Rajadhyaksha. I request all panelists to come on the stage, please. Shri Ribhu Tyagi, he is the Chief Digital Officer at Shivalik Small Finance Bank. With over 20 years in digital fintech, Shri Tyagi has led major innovations in payments, lending, and insurance, including faster payments at Visa and API banking at RBL Bank. A former CEO founder of Deal for Loans and president and COO of ECHO, he now drives Shivalik Bank's digital strategy, digital channels, and payments, focusing on future-ready initiatives. Shri Shishir Mankar, he is the partner, strategy, and transactions at EY Paranthenon. Shri Shishir Mankar has 25 years of experience in banking and financial services, beginning his career with BCG before moving to Axis Bank, where he served as Executive Vice President, leading corporate and financial institution sales and transaction banking products and solutions. He later headed financial services at Praxis Global Alliance and currently brings deep strategic and operational expertise to EY. Shri Sujay Vasudevan, he is the Head Risk and Compliance at M2P FinTech. Shri Sujay Vasudevan brings nearly 25 years of experience in banking and payments across business development, fraud risk management, and process migration. He has led risk, cyber, and intelligence functions at Citibank, Visa, MasterCard, and CA Technologies, driving fraud preventions, data security, and payment security innovations across regions. Before joining M2B FinTech, he headed MasterCard's Cyber and Intelligence Solutions division. And our moderator for today's first panel discussion is Dr. Niranjan Rajadhaksha. He is the Executive Director, Research and Strategy at Artha Global. Dr. Niranjan Rajadhaksha has built a career straddling research, policy, and journalism, now guiding Artha Global's research agenda with interest in macroeconomics, political economy, and economic history. Previously, research director at IDFC Institute and executive editor at Mint, he has shaped public discourse through influential columns, data-driven journalism, and policy engagement. His work has earned multiple national awards, advisory roles, and board positions. I welcome all the panelists to NSE. So before we begin the discussion, we have an interesting quiz for our young participants. Can we have the QR on the screen? So have all your phones ready. Please scan the QR code that you see on the screen. If you're not able to scan the QR code, you can go to the site www.slido.com and type the event code, which is MSEPP. Enter your name and your institution name. So there are a set of 5 MCQs, which are all related to the first panel topic. And they're all MCQ questions, so you will have 4 options. You have to choose one. Each question will be given 20 seconds, but you have to be as fast as possible because the fastest 3 are going to win the trophy. I think we can move to the first question. So you have to choose any one from the 4 options. Okay. Next. This is the final question. Thank you for joining. Now we have the leaderboard. So the first three are the winners, and I request them to come to the stage after the panel discussion is over. Thank you. And we'll now begin the panel discussion.
Thank you, everyone, and welcome to this first panel discussion. We're going to discuss India's digital payments revolution, talk about what has happened till now, what are the challenges, as well as some indications of the road ahead. So I just want to share some facts because there are a lot of students here. It's interesting that this is actually the 10th year of UPI. I think 2016 was when UPI was first, it had a very slow start and then it sort of took off really around about 2020 or so. The latest figures show that the monthly transactions on UPI are about 20 billion. The value of transactions every month is around 25 lakh crores, that's 25 trillion. So that's, and you know, it's ubiquitous, right? None of us can actually exist today without UPI, without digital payments. So we have a very distinguished panel here with experience at the cutting edge of the payment system. If I may just start with a broad opening question before we drill down. The success of UPI, what do you ascribe it to? Means we know that there's talk about an India model. We have a lot of students here, so you know, there's a lot of India model. There's talk about the India stack, the interoperability that is designed as a public good rather than any private thing. So broadly, what are the reasons for UPI's success? Perhaps Sujay, if I can start with you and we'll move this way.
I think the brilliance of UPIs is really in the simplicity. It was designed as a layer which people could connect to. Those are individuals, merchants, financial institutes. And being an API, being a layer, it allowed for everybody to innovate on the customer experience or the user experience. Go back maybe 10 years, if you had to go and buy something at a shop, you would have to pay cash or you would have to take your card. The merchant was fully involved. He would give you a receipt. Today, the biggest difference is merchant gives you the amount, merchant goes on to the next thing, payment happens, he gets a sound box, he gets intimation. It becomes simpler. So it is simpler for the users because they don't have to carry money, they don't have to carry a card. Simpler for the merchant. And moment cash handling became less, it became useful for everybody. But I think the simplicity of the solution, I think, was the biggest thing, according to me. Yeah.
Maybe to add on to what Sujay said, I think happy confluence of factors that came together. If you look at many systems, India has leapfrogged what was commonplace in Western markets. For example, the mobile leapfrogged the landline in India. And so I think we have therefore been able to leapfrog this entire card form factor along with its natural expenses and constraints by creating UPI, and many things like the simplicity of the design, the way it has been created in a modular way where every piece of the process can be done by different people who can bring their expertise, and that design I think has had a lot to contribute to UPI. I think plus the fact that, as the way and Professor Sudarshan talked about the infrastructure created in terms of authentication, Aadhaar, the bank accounts being created, where 90% of adults today have bank accounts in India. So I think all that was a very good level playing field on top of which the product eventually saw success.
I think UPI for me was like a perfect storm. Demonetization was an external event that kind of gave it the significant push that was needed for multiple stakeholders to come together. So I would put that as like number one, like what got all of these participants to come together. Simplicity that Sujay talked about for sure, but also the universal coverage of it. It wasn't that any bank was left out, the fact that fintechs could participate in it. So I would say multiple pieces of the puzzle all coming together, precipitated by demonetization, is what led to UPI where it is, and the momentum is just building up.
So, while I think all of us agree that UPI has been a great success, and I think it's globally accepted that the Indian model has been very effective, one of the things is that there are still exclusion issues, right? In the sense that I think there are about 500 million active UPI users, while the potential market is much more. And in fact, my firm had done a survey, and there are various reasons, right? Lack of access to smartphones. Sometimes there are internet dark zones where connectivity is an issue. There are issues of trust. So, do you feel that, forget the future innovations, but even now, despite the success, there is still more to be done? Just getting more people into the UPI framework. There's been the experiment with UPI 1, 2, 3, etc. So, Rebu, if you could start with you.
Sure. So firstly, I think any goal on inclusion or any goal for any digital adoption should be kind of tempered, because any digital mode of payment also comes with inherent risks. We heard the previous speaker talk about the potential risk, especially around people who are not fully understanding what is it at play, right? So one, I would say that it's fine that there will be phases of growth and phases of adoption. Second, I think what really helps is looking at multitude of use cases that go and unlock each and every kind of an ecosystem at the periphery, which will then come online, use UPI for the first time for a specific trigger or the nudge that really resonates with them. So I think these two things is what I would focus on. One, that we should temper it, we should not, and it is expected to happen in phases. And I think that's what we are seeing in the Indian market. And the second is that for those phases to keep on building, you need more and more use cases, you need more and more next year kind of solutions to come, and all of this to be built together again in the ecosystem.
Yeah, so I'll perhaps come back to the point of use cases a bit later. But Shishir, any thoughts on this, that more people need to be in UPI eventually?
Yeah, I think it's the reality is that we are a heterogeneous, multifaceted country, and so I think to assume that everyone will fall into a single template is almost perhaps futile. And so I think we need to be ready for a scenario where there will be multiple ways of making payments. People will use UPI in multiple ways. I think there are some, while I think it's been a great journey, we are now hitting a place where the next wave needs some next level problems to solve. For example, if my income is in cash, how do I even get to use UPI? Because then I go back to the same problem of saying I have to spend half a day to digitize my inflow, and then we are back to the old problem there. There are challenges of course, network, smartphones, but also there are challenges of risk and inhibition and fear of the unknown. While the easier pickings have been taken, the next wave will need different stakeholders to come together in different contexts to encourage people to tip over. And I think that might be the way we will see. But I think it's almost futile to say there'll be 1.4 billion people using only UPI. I think that perhaps is not the end state to aim for. It is, it'll set us for failure.
Yeah, so one of the insights which we got from our survey is that actually UPI and cash are not substitutes. They're actually complements. That we will, of course, in various parts of our life be cashless, but cash will have some. So, Sujoy, anything to add on this? That how do you actually deepen the current UPI as we have it, especially in rural areas, excluded communities, women, get more of them into the net?
Yeah, I think it's, and I'll just digress for a second to try to emphasize it, right? There is always a trade-off between convenience and risk. And that comes into light because what you're trying to do with UPI, what we've achieved with UPI is the simplicity part. It's very easy to make a payment, but there is a risk of it that you have to be at a level of financial literacy that you're able to manage it. So we've had issue, I mean, when we've seen in a bank that debit cards were given to in a slightly rural area, and one person used to go collect all the debit cards, take all the pins, and travel 20 kilometers to the ATM to get cash out. So that level of trust was there, but that trust in digital world changes very fast because the people you're interacting in a digital world is no longer your friends and family. It could be someone sitting miles away who's trying to take an advantage of you. Where does it lie? I think technology has come in. It's made better security or reduce that risk without impacting the user experience. And more technology, and as that technology starts getting deeper and less intrusive, I think that adoption into the interlands will increase.
So in a way, the simplicity is the feature, not the bug of UPI. But the simplicity also creates problems because you may just fall for that quick scam or, and as you say, I completely agree that just financial literacy, digital literacy has to be deepened. But just to stick on the technology question for some more time, besides misuse of UPI, which I don't think is massive, but it's just at the edges, these stories keep coming up. There is the increasing issue of outages, right? Now, this is partly because of the business model that there is this tussle that should UPI be free. That's what has made it so ubiquitous. Any thoughts on this, that is the technology infrastructure of UPI lagging the actual usage, or is there just something about this outages?
Yeah, see what happens, and UPI has not one or two players. Every UPI transaction touches at least 4 different players, right? And unfortunately, the model is that at any one of those 4 players fail, the transaction fails. Some people have got caught off guard with the level of scaling. Some of the technology, especially if you look at some of the legacy technology, has not been able to scale. I think that's something, at least from an NPCI perspective, is being monitored a lot more now. They introduced new policies just last year on how this is going to get regulated and controlled. So it should see an improvement. I think UPI Lite is a great feature to circumvent some of those issues. But yes, I mean, this growth is going to continue. So I think it's, for everyone, all players in the market have to, come up on that.
Yeah, Ribu, you had mentioned use cases, right? And you work in a small finance bank and obviously active on the lending side. It was mentioned, that your payments history gives you a digital trail, and there's also the entire story of the GST network giving you a transactions trail. So how do you see the potential of UPI, either directly or indirectly, leading to more financial inclusion on the credit side, that people who do not have collateral, people who do not have a track record, which is perhaps a large majority of Indian small enterprises, getting better access directly or indirectly through the UPI system?
Okay. So I'll take 30 seconds to go back to your previous question. I think the tech stacks that we had 10 years back across the ecosystem, not just at the banks, but tech stacks which were not probably designed for very micro payments, high volume micro payments, right? Now, coming to the credit part of it, I think the growth engine for any economy, especially like ours, is the MSME sector, right? And if you look at it, this informal sector, the one core requirement for them is access to affordable credit, right? And we've been talking about it, alternate data-based underwriting for a while, but that data was not really available in a structured format before digital payments could capture the cash inflow, which is truly reflective of the nature of the business of this micro entrepreneur. So one, I really see this as a segue for access to affordable credit in that segment. But for that to really get unlocked, there are a lot more other things that need to happen. First and foremost, and this will take us back to Professor's session, where he was talking about identification being made via Aadhaar, so onboarding became easier. Jandan ensured that there were bank accounts on both on the send and the receive side, et cetera, et cetera. But what we need is that, unlike money movement, which is payments, if the funds are good and the sending side has authenticated it, it will terminate if the recipient account is a valid one, right? Unless and until the receive side switches down. Credit doesn't work like that, right? Each and every institution will have their own thesis around who to lend at what rate, and it still continues to be a business where you want to reject a few applications because of your ability to collect, etc. So my sense is, and having worked really closely on OCEN, which is a DPI for affordable credit, that we are making significant steps and we are making good strides towards inclusiveness on the credit side. It is a strong driver for growth. There is a fundamental need on the MSME side for this to unlock growth at their end, but it will happen in pieces and phases. A lot more needs to be solved for.
Shishir, a lot of the discussion on UPI tends to be on the consumer side, but the flip side is the merchants, right? So, any sense about how UPI has played out for merchants? Because it even plays into this entire point about credit, that because merchants also have had problems with UPI, but they've also benefited. So, any thing about beyond the consumer, the other side of the transaction?
Yeah, I think and like you said, Niranjan, it's a unsung side of payments. For long, we focus on the payer and not as much on the receiver. I think one interesting study would be to contrast cards versus UPI. And I think with due respect to all my cards friends, the card industry is very issuer focused. I think UPI has really allowed merchants to have a, I would say, reasonably equitable stake at the seat at the table. And while we didn't discuss it, to me, the magic wand of interoperability was a big switch, because in the card network, merchants would have multiple terminals, they're dealing with multiple banks, but now you can deal with one QR, or maybe you want a backup QR, you can have a second QR. And I think that allows them also to consolidate their digital footprint on a single place, and then there are extendabilities on lending. And I think to the credit point, this is partly linked. I think that my hypothesis is that the big success story UPI can write is on providing production credit to commerce, because that is where it is linked most closely to the transaction. And wherever we have industry has combined commerce and lending, it has generally been a good experience, because there is a good purpose for the credit. And I think that's where to me, the big impact of credit can potentially come, where we use UPI.
Yeah, because the building blocks are there, right? So you have this entire idea of cash flow based lending. You have UPI, you have the GST network, you have the account aggregators, but somehow it's not taken off as yet. So perhaps any thoughts?
Yeah, maybe I think that and Ru mentioned it. So lending is not just about access, but it's also about assessment, assistance, and finally collection. And I think we have access, perhaps we could say we have solved maybe the proverbial 80 or 90%. I don't think we are there on assessment. We have made great progress. But the reality is that the borrower needs assistance, because that pat on the back from someone they trust is important even in lending. And that needs to be baked into the business models. And many lenders we know have made the mistake of saying, okay, I have done all this hard work, the money will come back on its own, but hey, it doesn't happen in lending. And so not closing the loop on collections and recovery has been a fatal mistake. And then you have one accident and you take 2 steps back. And I think that's a learning phase that we need to put the right models. I don't know the answer, but I feel all these blocks need to be there. Lending is inherently more complex in that sense.
Another sort of challenge is the concentration of market share now I think the Reserve Bank is concerned about it, and a lot of others. And we saw it in a very different way recently when Amazon Web Services went down, a lot. So in a digital economy, there is a certain agglomeration effect which leads to monopolies, but it also creates risks. Any concerns, especially given the tricky geopolitical situation we are in, about the concentration of of a few players? No need to name them, but it's not about them, but it's about the market structure.
I mean, it's there. I mean, there's very little that can be done in the short term. There are initiatives which you're all aware of by the government in terms of whether it's India Stack, whether it is RBI coming with data centers to de-risk some of it. But those will take its time. I think adoption will be more ground up, and I'm talking about smaller financial institutions then moving to the larger ones. There's been a lot of de-risking by the larger institutions as well by moving a lot of the services which are running on outside into in-house, and that's mainly on the data center part. In terms of payments and having, especially for UPI, a number of players, yeah, that is going to be there, and we just have to wait and see how that plays out. Ribu, I'm sure you have more on that.
So I think from a concentration risk, there are two parts to it. One is the concentration risk on the front-end side in UPI, what we would call the TPAP side of it, right? And if we double-click on that, you would notice that these are entities who probably solved for customer experience in terms of designing their journeys really well, and also had a lot of money to burn to onboard these customers in the early days. Whether we would have the N+1th player having the same kind of incremental design, which nudges a customer to move from the existing ones to the new one, or the new ones would have the kind of funding and the dollars to burn, remains to be seen. On the other side, there is also the concentration risk on the banking side of it, right? And not just the bank part of it, the tech rails that actually move the money, right? That, to a large extent, is something that is getting structurally solved in my mind. So I would look at concentration risk at these two levels.
Shishir, any additional thoughts on this?
No, I think, these risks kind of do reside, but I think the regulator has also been at least looking at resilience as a new thematic now, saying how do banking systems which have public money and which provide public goods like payments being one or credit being one, how do they think from an end-to-end perspective and build resilience? I think is a big call out, I think, and all the banks are working on it. I'm sure the TPAPs and PSOs also must be working on it. So I think it needs a systemic solution. It's something we need to go through, I guess, but I think it's definitely on the top of the table.
Okay, so UP has been a great success. There are some challenges of inclusion, of perhaps fraud, of concentration, getting it on the same success on the credit side. But there's a road ahead as well. And the professor said that, oh no, was it Shailesh who said that we don't know what's going to happen in 20 years. But let's challenge him for some time, right? So, not 20 years, but what do you think are the most exciting things which could happen in the digital payments space in the next 2 years, 3 years, whatever? Means feel free to define your time space. Ribu, we'll start with you.
Interesting thought. 5 years? So a couple of things. Something we didn't talk about. So I don't know if a lot of you have been to tier 3 or rural parts of India. When we talk about digital payments, we usually don't picturize the scenario of assisted payments, right? I've been fortunate enough to work with a company which was running an agent network. There used to be a lot of volumes for cash in, which is, let's say, a laborer earning cash in Delhi wanting to send money back home to a bank account in, let's say, Bihar. And there was a cash out network. And I would want to take a minute before I come back to your question to acknowledge the role of this set of and category of players who have helped the financial inclusion and the adoption of the digital payment rails. Because again, at the periphery, maybe there is a delta lag in terms of digital adoption. For digital payments to be adopted there are a few things to happen, right? The end consumer needs to have a mobile, a smartphone, let's say a feature phone, should be comfortable with doing those kind of transactions. But a lot of that has been being solved for a n number of years by this agent network. So just wanted to take a minute to acknowledge the role played there. So to the question around next 5 years, what's going to happen? I think we are seeing that credit card growth was 17% year on year, or something like that, and the UPI growth was probably 3x more. I think with credit coming on UPI, the growth of credit on UPI will be very, very significant. We have seen that on the card networks had a disproportionate share of on the credit side. I think that is the market that's going to be eaten by UPI in a very, very fast pace. That's the one thing that comes to my mind immediately. Next 5 years.
Yeah. Shishir?
Yeah, I think on the domestic payment side, I would call out the 3 V's. I think there is voice, there is vernacular, and there is video. And layering all these on top of the UPI rails can perhaps take UPI to the next 20 crore or 30 crore or whatever that number of Indians is. Because again, like my son, for example, talks to Google, he doesn't type. And I think that the future of generation will talk and not type. So maybe we need to layer this. This is one. And I think, of course, there is the cross-border, which is, even if you look at small ticket retail, individual cross-border is about, I don't know, 125, 130 billion dollars. If you shave off 1% of transaction cost, you're talking about $1 billion. Yeah. It's not a small amount of money. It needs a different wiring. You need a bit of a FEMA and a bit of a banking and a bit of a tech, and it's a different wiring. But I think it's something that is definitely worth solving.
I suppose remittances also
yeah,
are.
all of that.
Yeah. Okay, fine. Last word, Sujoy?
Yeah, I mean, I think crystal ball of payments in India will probably a boardroom discussion in NPCI.
Sorry,
I said the crystal ball of payments in India is probably looking into the boardroom of NPCI. I mean, the innovation is, is at a very, very fast pace. You look at, UPI Circle, there's UPI Reserve now, which is coming up, cross-border, which Shikar covered, multiple countries, either directly on UPI, integrating with other things. I think we are already way ahead of the world. So recently we went with family for a short holiday in Southeast Asia, and every place was, cash. Hardly 10% was cards. And finding an ATM, having ATM daily limits was complete nightmare. Because end of the day, the taxi driver said, no, I'm taking cash. And landed back in India, and we just realized how easy it is today to transact, how easy it is to, just take a rickshaw from, somewhere, reach home, pay by Google Pay. I don't have to worry about whether I'm carrying cash. I think we are already, in the future compared to the rest of the world. How does this go to the rest of the world? How do we enable cross-border? What else can NPCI conjure up? I think these are the things I'm looking forward to. Closer to home, closer to heart, the use of AI, use of data for security. And as I said earlier, I see security as the way to really expand into the really into the rural areas. I'm hoping to see a lot more of that. I know a few startups are already working on UPI fraud, and I'd like to see a lot more of that going on.
Thank you very much, all three. We have time for about a few questions, say 10 minutes. You have 3 of India's best experts on digital payments, so please use this opportunity, especially the students. Any questions? Yes, please.
Hello. Good afternoon to all the panelists. So my question is on the sustainability of UPI. Like we have seen, like there is a cut on the funding from RBI and the government side to all the banks and all. So my question is on the scalability and how sustainable is UPI going ahead. So yeah. like what are your insights? Like, can we make this sustainable, or like since banks and other all the intermediaries are not able to take a MDR on the UPI? So yeah, my question is on the sustainability of UPI.
Thank you. You want to go? Yeah.
I think it's about the perspective as well, right? Fundamentally, if you look at a bank today, if I'm dependent on cash, bank has to handle cash, bank has to have ATMs, it has to distribute the cash, has to collect the cash. There is significant amount of savings from the bank on banks because of UPI, and I think it's left pocket, right pocket thing. Whether that will transcend into all users, whether that goes, because I'm saving on cash handling, a merchant is saving on cash handling. I think that policy will decide eventually. But I think even at today's rate, just the fact that the amount of cash and cash handling that UPI has, got rid of, I think is significant at the industry level itself.
Anything to add, Shishir?
See, I think the other thing to focus on is what's driving the choices for, let's say, a merchant or a consumer, right? And let's split that into the two. As a merchant, if you really want to accept payments digitally and focus on, low-cost payments coming through, zero or not, currently there are very few choices. And unless you are really ready to let go of business coming to your shop or to your small business saying, I will accept only cash or I'll accept only cards, I would assume that universe of merchants is far and few. Similarly, on the consumer side, given the vast adoption of UPI on the merchant side, the acquiring footprint of UPI, and on the fact that if you are even doing a P2P payment, the recipient on the other side is probably giving you a handle to pay to. Or if you hail a Uber auto right after this and you want to pay to that Uber auto guy, chances are that auto guy is going to force you to use UPI. So I think we are at such a scale where unless something really drastically goes wrong, the pure economics sense of accepting it and the pure scale and the number of use cases where you will be nudged or tunneled into using UPI, I would place a safe bet saying that sustainability doesn't seem to be a challenge in the near future.
Shishir, you want to add
Yeah,
anything?
I think there's a concept in economics called social return and financial return. So maybe the financial return is not easily attributable and visible, but if there's a social return, and I think everyone is arguing that there is a social return for all the stuff that is being built, then I think the question is not whether UPI is sustainable or not, but are we able to share the social return amongst people who seek financial return, and that's the problem to solve. I don't think that the sustainability of UPI is perhaps at this point, I think it is just to center stage now. And I think the challenge and ask for all of us in the system should be to build monetization models on top of that, which help us to defray all the investment that has gone for all the good reasons it has gone for.
Yeah, Nirupama, please.
Thanks for the very interesting, views. I have two questions, one for Mr. Tyagi. I think you were talking about sort of two ways that concentration, arises. One is the front end and one is on the banking side. If you can just elaborate a little bit more on the banking side, because I think you referred to how structurally it was a little bit solved. And the second question is more broadly. We have seen that UPI has had a big effect on the credit side for the retail segment, but not so much for the MSME segment. So I'm referring to things like not just the Kirana stores, but maybe the slightly larger firms. And more broadly, not just UPI, but account aggregators, trades. Why are we not seeing, what's the friction? Is it tech or is it something else? Thank you.
All right. So you wanted deep dive on the second part of it. In the back end, see the money flows like Sujay was talking about, multiple hops, right? So there is a send side bank, there is a UPI switch on that side, there is a validation of the account that kicks in, then there is a TSP that would be sitting between the bank and let's say the network, and similarly on the receive side of it, right? So a single transaction of UPI would move from multiple points in the what we would call the tech network, right? Now if the number of players who are passing and managing, let's say 80-90% of the overall UPI transactions are just a handful, there's a potential concentration risk on the backend side as well. It could also manifest not in terms of tech, but I won't take the name, but we had an incident where, let's say, a large number of handles had to be regenerated for the customers. And for that particular fintech, it was about how do you mass re-onboard the customers without getting the customers to the journey, right? And hence, you would see some of the other fintechs creating handles across 4 different kind of banking partners, right? So there are concentration risk at the back end also and the front end apps that you would use. Yeah.
And the second point, which was?
All right.
No, please go ahead. I think MSME, maybe someone can answer, but I really think what UPI has done is redefine what a merchant is, right? And I'll just take an example of my wife's village, which is easy to describe it, saying, if I go to my wife's village, the closest Pepsi I get is 7 kilometers away, so it's that small. But there's a boy out there who basically starts selling stuff on buses which go. He gets in at one stop, gets out at the other, and he's able to sell, and he does all the payments he gets on UPI, even though it's rural, even though it's village. Right? So that's a merchant of today, is actually an individual who's accepting UPI. I think UPI, end of the day, we should understand, is a B2C. It is a business to consumer. I've not seen too many B2B cases or use cases, unless you gentlemen have anything to add.
Maybe I think like I said, the intuitive point of sale financing inevitably is a consumer finance. I purchase something for, let's say, 5,000 rupees, and can you divide by 3 and do a 3 EMIs? When we come to understand the merchant, that 5,000 rupees is grossly inadequate to meet their needs because they're running a business. So we need to talk about larger ticket sizes. And when you go down that path, you realize that you have to understand the business, which is very heterogeneous, because a kirana store in a busy area from a less busy area in a different city, and a pharmacist, and there is benumbing complexity. I think that is the problem that needs to be solved to deliver merchant credit. So yes, what UPI does is it brings visibility of credits. But how they sit in the merchant's business is a problem that the lenders need to solve, and that's work in progress.
Sorry, Shailesh, you have a...
Check. I wanted to read out from this excellent report that Arthur has prepared. These findings point to a key perception gap. Although UPI is technically capable of handling large value transactions, many merchants don't consider it reliable or secure enough for such use cases. For UPI to become the preferred mode across the value chain, changes in transaction limits and redressal timelines will be necessary. So if I'm paying 5 lakhs to someone, I should be able to pay it through UPI, right? But it doesn't happen right now. Why?
So I think if the current intraday limit is 2 lakhs, the updated one, right? One per account per day, right? So firstly is the overall transaction limit and the intraday limits. But more so, I think we got to figure out what is the right solution for the use case. The merchant is trying to make an account-to-account payment, right? The merchant has let's say, is paying a supplier, has the supplier's bank account credentials available. This is a one-time onboarding. If you look at a larger merchant, then there are ERP systems at play, right? So the movement of money is probably what happens in the back end. But for a particular rail to be preferred, there has to be economics, there has to be the front end, and a logical value that it delivers to that particular merchant. In this case, when we talk about big corporates making payments to other big corporates or small corporates, the ERP systems run with RTGS and other kind of rails sitting in between, right? There is, in my mind, very limited kind of incremental value that gets delivered to such a platform by shifting it from the current rails to UPI. But when we move it to, let's say, a individual kirana shop, it becomes so much more intuitive. I find it very clunky to, let's say, as a shopkeeper, open my banking app because it's not designed for a high frequency kind of payment mode. I probably find it more comfortable doing it out of BharatPay or some other acquiring kind of an app because they've really used that lens to solve for my individual use case. And hence, the UPI is the rail that gets invoked there. So I would probably look at it that way.
I'm going to take one more question from the okay. Okay, fine. Oh, there are more. Okay, fine. Just one and there are two questions.
Hello, sir. I am Jatin Sharma. So, sir, we have recently talked about the high adoption rates of UPI.
Can you speak up, please?
Yeah. So, we have recently talked about the high adoption rates of UPI that have been rising continuously, and we have seen a good surge in UPI rates as well. So, sir, what do you feel are the bottlenecks for semi-urban and rural India that will come up in future, and how can we come up with the challenges that come further?
Maybe we'll take the second question as well, and then.
Sir, I wanted to ask about the inclusivity that you addressed through the panel. The inclusivity that was discussed mostly was about inculcating more people as in consumers for UPI. My question is, does the future also hold the disconnect that we experience as consumers, where UPI is not connected to cash payments and UPI is also not connected to card payments? Could we also say that along with credit we could incorporate something like gold into UPI, or expanding it to other forms of currencies like internationally, so that like the inclusivity is not just lateral but longitudinal as well?
Shishir, you want to?
I'll try and take partly connected questions, partly not. So I think like at some point we did describe some of the constraints for usage of UPI, fear of technology, unproven case, assistance at the front end need to be solved. And I think to link to your question, some of this stuff it's underway. For example, we are using UPI for cross-border, right? In some ways, you can argue UPI is connected to other modes in India. You have a bill payment framework, but you can top it up with a UPI transaction there. So UPI has the ability to sit on top of many other systems, and it's a work that we need to do. I'm not sure I can visualize how we can link it to the actual cash, but so long as everything has a digital footprint, I think UPI technologically has the ability to do that. Then we come down to a question of economics and interests. Who is participating, why should they participate, and that's something that needs to be solved. It's not a tech question. I think UPI has proven that it can be very versatile. We have to solve the business questions to make all this truly interoperable at like very grand scale.
So I'll try and answer your question. Imagine a block of Legos that you've got, right? And imagine the red color Legos are UPI. You've got a core set of a block built. Now, not everything has to be red colored and integrated therein. There are other things that you can bring in. And so long as you're able to connect to it and deliver the end use case of financial inclusion, where let's say the source of funds is gold getting converted into, let's say, a line of credit that being used to make a payment on UPI, those things are happening already, right? So don't assume that everything has to flow via UPI. UPI has to do its job, which is to move money, and across all the use cases that we talked about, low bandwidth, offline, etc., etc. But for every other inclusion, the way you are looking at it, I think the key ask is, if I do the edge scenarios, would UPI be able to carry forward and terminate the payment leg of the transaction? And the answer currently is yes. So I would request you to think of it from that perspective.
I think we're more or less out of time. So Ribu, Shishir, Sujoy, thank you so much for sharing all your insights on digital payments and also looking a bit ahead on the future of digital payments. Thank you very much.
Thank you, Niranjan.
It's not announced. So we'll have the felicitation. I request Dr. Dathankar Patnaik to felicitate our panelists. I also request Dr. Manisha Karne to felicitate the panelists with the MSEPP mementos. We also have mementos from MSEPP. So, Dr. Manisha Karne, she'll felicitate the panelists. Just we have the mementos from MSEPP. I request Dr. Rajadaksha to please be on the stage. We have the quiz winners and we have trophies for the quiz winners. So could we have the winners of the first quiz on the stage? Shiptain Sheikh, Anish Joshi and Janvi Duba. And could we have the questions on the screen as well with their right answers? So we have the right answers on the screen. So Shiptain, he got all the answers correct. And the last, Ms. Janvi Duba. So she's the third fastest. Thank you so much. Thank you. Thank you to all our panelists and moderators. We have just finished our first panel discussion. We'll have a short break of 5 minutes and then we'll move to the second panel. So you can just grab a quick cup of coffee or tea and then come here. We'll assemble in 5 minutes and we'll start the panel discussion. I request all our participants to take their seats. We'll start the second panel soon. I hope everybody's feeling refreshed after a cup of warm coffee or tea, whatever you like. Yeah, we can start if everybody's here. So it's time for another interesting panel. The topic for the second panel is new forms of financial intermediation. With the rise of digital lending, AI-driven credit models, and alternative platforms, financial intermediation is changing fundamentally. The second panel will examine emerging models and their regulatory, technological, and inclusion implications, and what the financial system of the future may look like. Our panelists for this session are Dr. Nirupama Kulkarni. She is Additional Research Director, CAFRAL, where she works on banking, household finance, real estate, and monetary policy, with a focus on how government actions shape credit and financial markets. She has received multiple research fellowships and grants, presented widely at academic and policy forums, and continues to contribute valuable insights to India's financial sector and policy landscape. Our second panelist is Shri Deep Narayan Mukherjee, Partner and Director, Risk Management and Data Science at BCG. Shri Mukherjee is a financial risk management expert with over 2 decades of industry experience. Before joining BCG, he served as Chief Product Officer at TransUnion Sibyl, leading product development and research, and has held key roles at Fitch Rating and American Express. He frequently writes for major financial dailies and also teaches risk management as a visiting faculty member at IIM Calcutta. Shri Sandeep Kojalgi. Shri Sandeep Kojalgi is a senior leader in India's fintech and inclusion space, serving as Senior Vice President at Center for Innovation, Incubation, and Entrepreneurship, where he guides incubation and acceleration programs for startups, inclusive fintech, livelihoods, and skilling. He previously worked at Innovity as a product manager and at Accenture as a consultant, gaining deep experience in payments, technologies, and operational strategy. And finally, we have Dr. Dithankar Patnaik, who will be moderating this panel discussion. Dr. Dithankar Patnaik is the Chief Economist at the National Stock Exchange of India. He brings over 2 decades of experience across research, consumer banking analytics, equity strategy, and macro market analysis. He has held leadership roles at Citigroup, Religare Capital Markets, and Mizuho Bank. A former researcher at IGIDR and an active visiting faculty member, he is widely recognized for his insights on India's economy and financial markets. I welcome all the panelists, and may I request everybody to stand for a group photograph, please. We'll also have the second quiz, which was related to the second panel. Could we have the QR for the second quiz, please? Do we have the QR? Okay. think we can move on to the questions. Which of the following is a government-supported fintech sandbox initiatives? The correct in RBI Innovation Hub. That's the correct answer. The main advantage of tokenization in financial markets is? Okay, so most of them got it right. It converts real assets into digital tradable units. Neo-banks differ from traditional banks because? Okay, good. The first one is the right answer. Good. And the final question. Yes, option C, that's the correct answer. And now we'll see the leaderboard. Anish, Akansha, and Samir, congratulations, you're the fastest three. And request you to come to the stage after the panel discussion to collect your trophies. And we can now start the panel discussion. Thank you.
Thank you, Ashiana. The topic of my panel here is a little esoteric. It is not the same as what we were discussing in the earlier panel, where we had UPI, we saw the pros, cons, the pitfalls, and the promises of UPI. I would take a step back in this panel, and I'll ask my fellow panelists here some questions on frameworks, some questions on the issues that come up with fintech, financial inclusion, and some of the topics that we've been discussing today. So the first theme that I would like to explore is on redefining roles, redefinition of roles. Now we are seeing a very quiet but profound change happening in our financial systems these days. And humor me this. So we've had institutional intermediation from now for a very long time. We've had banks, we've had brokers in markets, we've had insurers. Insurers pooled risks. Brokers got buyers and sellers together. Banks took deposits, gave loans. From then on, things have started changing. People have started, or the systems have started moving towards platforms. So the institution that you're sitting here
is also one that came in the aftermath of an event that happened in the early 90s. Most of you would have seen the OTT program that led to the eventual creation of the National Stock Exchange. But the idea that I'm pushing here is not just markets, but also banks. So we've had UPI, very well discussed in the previous program, another example of the same kind, which we would loosely call infrastructural intermediation. And infrastructural intermediation is where you don't have the traditional intermediaries like banks, like brokers, like insurers, but you have systems like UPI, and you have very similar systems like UPI, like ONDC, and one where one of our fellow panelists, previous panelists, Ribu, you worked at OCEN. OCEN is another place where you have the connecting function. You don't necessarily see the traditional intermediaries. So, and what's happening here? Technology is basically unbundling this traditional link with financial institutions that we have seen so far. So risk assessment, liquidity provisions, information processing, trust building, these are things that are coming up to the fore. And these are some of the issues that are changing finance as we know it, as we have seen it in the last several generations. Things are really changing. We don't necessarily look at what your bank is. We discussed so much about UPI. You don't necessarily need to know your fellow, your counterparty's bank accounts when you do a UPI transaction. In markets, this has been there for 30 years, frankly. I don't need to know who my counterparty is if I'm buying or selling in the markets. So from this perspective, my question to my fellow panelists is the following. So is this enhancing efficiency? Maybe the answer is very much in the affirmative. Is it enhancing competition? I suppose so. Again, although in the previous panel we had seen questions of market power sort of coming up. Or is it creating new opacity? Is it creating new kinds of system fragility? So this is my first question to you all. Deep, I'll start with you then. Are we enhancing competition and efficiency? Yes. But are we also looking at new opacity and systemic fragility?
So I think, see, two things are happening. It's not, in my opinion, necessarily that we are disintermediating. We had an intermediary in the physical world which was called a bank, brokerage, so on and so forth. And currently they are in some way being replaced by technology intermediaries, as you have said, infrastructure intermediaries. It's while the efficiency definitely has increased, speed of transaction has definitely increased, we do not know the full trade-offs as of yet. This is an early experiment, very, very early experiment. Appreciate, I mean, not just UPI, but every payment rail like UPI is possibly causing something first time ever in civilizational history, which is a common person would have to pay for the transaction separately. Never in the history of human economic transaction a common person had to pay. There was always something that inherently. So this is a new trend, and someone is capturing that payment. Now, intermediary normally in a good 99.99% of the transactions when no one cares about the intermediary. When that one failed transactions happen, then you try to find out who do I rush to, right? Now, a lot of the technology companies is not regulated to that extent. A lot of times we find various regulators of the world saying that big tech controls finance, but they do not regulate big tech. So what are the trade-offs for this? We do not understand fully. So yes, we have started an experiment. Thus far, the results are quite interesting, exciting, and things are on the positive. Do we know the full lay of land, etc.? We do not know. We can only hope that things would continue to remain this good, because we haven't done, say, for instance, connected systemic study. I mean, just as a matter of speaking, some of the systemic things are scale and complexity dependent. The complexity kicks in when a certain scale is reached. So I'm storing tons and tons of data, and if I continue this for 15 years, have we as a nation sized what will be the payments data storage worth in terms of energy and other capacities? And is it better than, is it conclusively and in a high confidence better than the dirty 10 rupee notes which you used to play around with for all this while? We do not know. Maybe we are in the correct path, maybe not, but we do not know. So I will pause there.
Thank you, Deep. There are new, you set the ball rolling. There are new forms of fragility that might come up today, and things which are probably getting overlooked in the sense of, on one side there is ease in every way, but there are issues that need to be looked at also. Nirupama, your thoughts on this?
Sure. Thanks, Dr. Tirthankar. So I might have a little bit of a long-winded answer, but bear with me. So I'm from CAPFRAL, which is basically an RBI-funded institution where we do research on public and academic research on macroeconomics and finance. And so given my background, I'm going to a little bit, cite papers, a little bit draw on previous research to make some of my points. And of course, when you're thinking about something like DPI and UPI and other things, or especially the new age technologies, then it's a little bit more forward-looking. But I think the past can still teach us a little, something about what's to come. And so sort of the broad points I will make, there are two big themes. One is that a lot of the academic literature, the research that has been done till now is focused on developed countries. And that means that, you can't really translate it to what's happening in India, the sort of the revolutionary changes that we are seeing here. So I'll make that point when I talk about UPI. And the second is that, we know things that might work at a smaller scale, but when you scale it up, it might not really translate. So for example, one case in point is that we know that, fintechs have been using digital trails to make credit, but what UPI does is that it sort of scales it up to a very grand scale. And now what is the impact? What is the impact on competition? So for example, if, I have a research paper where we look at what happens, what's the impact of UPI on credit. Now, of course, now we know what's happening. But ex ante, it's not very clear that there would have been this large impact. Studies which had focused on the US had found that digital intermediation, or more specifically fintechs, they did expand credit, but the expansion in credit was only to the previously included borrowers. So it was basically to the prime borrowers. Now with UPI, you could also expect the same. But in our research, we find we have like this sort of comprehensive overall credit from one of the largest credit registries in India. And we find that fintechs increase credit, but the credit increase is to the financially excluded, the new to credit borrowers. Now, this is again very interesting, and it contrasts with the experience of a place like the US. What Dr. Tirthankar was talking about was how does this relate to competition in the financial industry. And in our analysis, we find that both the fintechs as well as the banks saw an increase. While the fintechs saw an increase in this new to credit segment, for the banks, the increase was in the prime segment. And then now when we look at things like financial fragility, so there are also interesting implications here. So if you extend beyond UPI, if you think about open banking, there is this idea in the literature that open banking can have sort of these two effects. On one hand, it could mean that these new entrants can access new information, and as a result, there's innovation in the financial industry, there's more access to credit. But on the other hand, because incumbents like banks are being forced to share their data, it might also mean that they might not invest in the infrastructure to actually create that data. And so you might actually have a decline in access to credit. Now, of course, this is what's happening on the for digital technologies, but also it's changing the very nature of how banks do their business. So for example, something that has been documented in the literature is how accounts which are linked to, which are digitally linked, or the digital accounts, the depositors are more prone to flee. This is not really a deposit run, but what people have called deposit walks. There is this slow bleed of deposits away from mobile, enabled accounts. And you also see this in RBI regulation. So for example, RBI has asked banks to set this runoff factor for digitally linked accounts to prevent this bleed. And so overall, there are many implications for financial stability. A little bit of what we know comes from previous literature, but a lot remains to be seen. Thank you.
Thank you, Nirupama. Which gives me a segue to the next question, and this would be on credit. We will look at credit as a next theme after redefinition of roles. My third theme after credit would be on something that's on a topic which is very dear to us at the National Stock Exchange. It's on the democratization of wealth. And lastly, I would look at sort of regulations. But on credit, and Sandeep, this is for you. I mean, we've seen credit, the origination, pricing, distribution, all forms of access to credit or the pricing of credit, the distribution of credit, have been seeing some changes, have been seeing significant changes in the past few years. Earlier on, we've had, credit was a more human affair. You basically went to someone assessed your documents, and then decided whether to give you a loan or not. Today, the idea is it's becoming a machine. You basically speak to a machine. You have a scorecard. Things are great. And the big advantage, once told, is that access to credit becomes simpler, quicker, faster, and whichever way. Pricing becomes works better. But what are the flip sides? And this is where I seek your comment. On one side, you do have access to credit where earlier things took a long time. You have much faster access to credit. But the models that assess you for these credits, they could be dealing on data that is old. They could be dealing on unreliable data. For instance, you have machine learning models today that deal not only with your credit history, but what we call thin files. They look at your other data, where you are, what kind of transactions you've had earlier. These are supposedly, there to support you access credit, but they may not be very reliable. And so there are issues where if your credit history is bad, or if the model thinks you're bad, you don't necessarily get credit. These are some of the problems that one faces with technology coming in this space. Your thoughts on this, please?
Yeah, thanks. We work with a lot of startups. Many of them that we have engaged with have been looking at credit, especially for the underserved segments, people both from rural and urban areas. What we have seen, what we have observed with many of these, especially when it comes to, again, two types of credit. There's the productive credit, and then there's the consumption credit that we look at. Largely, I think this was also pointed out in the panel earlier, wherever we have a productive credit use case coming in, generally we have seen that it's considered the good form of credit. It ultimately leads to a better financial health, right? The challenge comes when you are looking at consumption credit. Again, not all forms of consumption credit is bad, because the consumption of whatever goods or service you're using ultimately should lead to a better life outcome. When that does not happen, when consumption is used for a purpose that will, make your life worse, that is really the challenge. Unfortunately, the fintechs or even any financial intermediaries, I wouldn't say wouldn't, but they really can't go that deep into identifying what's the purpose of, what's the actual usage of their credit. And that becomes a challenge of making credit easier, right? Because otherwise, whenever there is a certain friction involved in the credit, you get that opportunity to probably just claw back. And that doesn't happen when it comes to whenever you have credit very easily available, right? Now, one thing about credit is that unlike other products, like an insurance or the savings and all that, there's always demand for credit. You say, I want to give out a loan, you will get a lot of people coming in asking for a loan. For insurance, you have to go and sell insurance. For wealth, you have to beg people to, come and invest. But with credit, because you are the one who is giving the money, you typically get in a lot of interest. The challenge is, of course, of finding out the right person to whom you have to give credit, because ultimately you have to collect it back. The point that you made about this, when we talk of credit, when we are actually talking of, again, because the theme is around inclusion in some sense, because we are moving more towards an underwriting, a data-based underwriting model where there's probably very less face-to-face interaction, person-to-person interaction, do we end up excluding people, right? The answer to that would be, I guess, I would still say on the whole, I would still say we are better off. Because number one, because we are able to do things in an efficient way, we are able to use this alternative data, we are able to look at, we are able to bring in a variety of players, we are able to bring in a variety of innovations to be able to serve that customer in the right way. If earlier, the only option was to give an EMI-based loan, now with data, we can actually give them a different kind of a loan. Maybe if earlier it was about collecting every month, now there are models that can help you collect every day, right? So there are innovations that can come in because we are doing this. And that ultimately increases the inclusion. And that is extremely important. So net-net, we are better off. Are there exclusions? Yes. But the way to solve it is by encouraging more competition.
Okay. Look at competition again. Deep, I wanted to, on your take, on a connected thought here. I did mention that today on credit thin files, people are able to use data that comes well beyond their credit histories. Sandeep's point makes sense. I mean, on the whole, we are better off. Yeah. And what's important is to encourage competition. And, but I just wanted you to spend a few minutes on what is it that today technology allows us to see beyond the traditional credit history of a person. Some thoughts there. How does it help us and what are the pitfalls, please?
See, here I will, I think when we talk of data, alternate data, technology, I think we are deviating from the fact that very few lenders globally, or I would say possibly the most well-established lenders globally, which is a very, very small club, who actually assess the quality of the credit decision using decision science on whether the quality of decision was correct, which is agnostic of the outcome. In a boom situation, you will have bad underwriting, which will give you excellent result because the economy is doing well. In bad situations, even a good underwritten loan would default. A very small club of world's best underwriters, they look at the quality of credit decisioning. Now, on this heavy discussion, let me sort of make it slightly light. If you give a chimpanzee a machine gun, they will not win the war. So, if you do not know fundamentally anything about lending, you one fine day decide that I will use alternate data, I will use machine learning, I will do news and later, your portfolio will go to the dogs. And the dogs at some point in time will refuse to take it. Innumerable number of cases are there where people have been using machine learning and the default rate has been going because technology is itself like that machine gun. If you do not know how to use it, so if you know where the problem lies, right? And that's a, someone who's new to credit is not financially included. What possible information can you have about that person? That person possibly doesn't have a great deal of education. If you really, with their consent, get their mobile data, etc., you will find all the TikTok newses. And then some people have actually built a model where you have downloaded TikTok or not was was a credit variable. If you have downloaded TikTok, your default rate was higher. Right? So, firstly, you know, the richness of the data is actually a function of your lack of inclusion in the financial ecospheres. You will possibly have a Jan Dhan account, but you will have 1,000 rupees, 800 rupees there. Believe me, out of almost 23 years of modeling, you cannot make model out of that.
Do your homework, in other words. Look at the credit data,
What helps,
in other
alternate
words.
data often helps is, of course, in very unique ways. There are small businesses who one may not be, you know, I can assess the, so for a small business, the financial statements are not possibly of the highest quality because they are not audited, so on and so forth, and it's not required. Now for this person who has been accessing credit, can I get a holistic view of their cash flows? Now this person is not actually new to credit, but I will be able to underwrite much better. Similarly, if I go for rural credit and farm loans, using satellite data, I can actually do a much better job of underwriting. If you are a small business and I know your location from satellite, I can actually find an affluence perimeter of 200, 500 meters from satellite that does it have thatched roof? Does it have asbestos? Is it does it have like pakka roofs? What are the thickness of the lanes around it? Is it showing a lot of bicycles, auto rickshaws? Is it showing a lot of? I can create affluence. Now that's where your credit decisioning improves. But new to credit, it's a mixed bag. There are people who stay away from credit. They have strong account data, which you can underwrite. But as such, if you have not been included, unfortunately, I do not have any meaningful data other than force fitting whether you have downloaded TikTok or not.
So Deep, quick question. This is true for an emerging market and a developed market?
This is, see, I think the point is India is possibly one of the most data-rich countries in the world with meaningful data. And if you appreciate what India has achieved from 2008 onwards, I mean, touch wood, 17 years of retail credit growth without any major blow-ups. I mean, a lot of credit goes to RBI, who one can say is a tad cautious, but very rarely would you see acyclical steady growth. I mean, there are bits of bumps, hiccups here and there. So that is all the richness of a credit system. So one may argue that a lot of emerging country, the data ecosystem is richer than a lot of developed country. It's possibly flipped.
So let me understand you. What you're basically saying is, it's great to have this technology, but please do not miss. This is not at the expense of traditional credit underwriting, not at the expense of data on credit behavior.
It is possibly a mixture where you need, again, the focus is on decision quality, as in treating it as a science. Yes. Because I can argue the other way around. When I apply for a credit, they will take how many members you have of your family, of course your gender, your degree. Now, when you actually look at large data sets, you per se do not see a strong correlation with age. I mean, people below 25 may be slightly high risky, but if you are 35 vis-a-vis 45, there is no differentiation of credit. Likewise, if you are a PhD vis-a-vis a class, who haven't crossed class 8, the default rate is similar. So a lot of those popular perceptions of what drives credit, we do not see in data, which is like millions of data points is telling that some of this conventional thing is not a big driver of credit. On the contrary, I can say that, if I get your bank statement, and when I do a detailed analysis of your bank statement, out of 30 days in a month, on an average month, 15 days your account is zero balance vis-a-vis someone who has 5 days zero balance. Someone who has 15 days is higher risk. So you look at data, obviously there has to be a rationale, but it is not about blindly replicating what was there, because a lot of data that is gathered today, they are not borne out by empirical evidence, they add value. Things like account aggregator, etc., opens us an entirely new range of data which was looked at, but was not information was not extracted with technical savviness.
I was going to ask you about that, yeah.
That's adding, that does add a significant value over conventional sources. And people are using it, banks are using it, lenders are using it very successfully, but then again, it's not blind application.
It's not blind application. Nirupama, the account aggregator model, where Deep also spoke about maybe cash flow based lending. there's a firm, there's an MSME that has a credit history, not due to credit, but can look at a bank or any intermediary can look at its transactions earlier and therefore look at lending based on cash flows to provide loans where earlier things were difficult. How is this taking place in India, and have you seen any such examples elsewhere where India could look forward to, or are we leading the game in this area?
So so broadly for account aggregators, I think I've been trying to study the space for a while, and I think I've not made much headway. And the whole reason is that in the very beginning, there's not much going on, and from the outside, it's a little bit. I don't know what the friction is. There's a lot of promise. So you saw that on the UPI side also, the idea that now you have digital trails, and hence on the retail side you get access to credit. One would think that would also translate to something like account aggregators, where you have access to bank accounts, but maybe for like MSMEs you also have access to their EGST and so on. Yes. But there isn't much, and I'm not very sure where the glitch is, why this isn't happening.
You get numbers like credit is now over 1 lakh crores. I know there's nothing in the big scale,
yeah.
but what is the hindrance?
I cannot make out from the data. I don't know in the last 6 months there has been a big jump up. I don't know what has happened that there has been a big jump up. And again, I've been trying to study this for a while. And I think without data, again, the punchline from what I've said previously is that I think, if we don't know what were the frictions, what got fixed, then we won't know, where we are going forward. So for example, I have spoken to some people on the business side, and they say that account aggregators, they're very glitchy. And in fact, you just get the direct pull of EGST, and that's how you can do cash flow-based lending, but not through the account aggregator framework. And I've still not understood, and even the way the data is, you can access different kinds of data through the account aggregator versus the direct pulls, and that seems to be the difference. But it would be nice to know, especially from people on the industry side, exactly what is happening.
So are these teething troubles, and we'll see things pick up in a hurry? Because it seems to me that the MSME side does need credit, and if credit is available from these means, on cash flow based lending, things should be helpful. And let's remember, when 2017 GST came in, this was one of the advantages also bandied about on GST, that it will allow cash flow based lending for credit where generally things weren't available. And I will tell you that the success of schemes like ECLGS in the aftermath of the pandemic, time and again, have shown that this space does have significant demand for credit. Then what could be going wrong?
That's true. It could be teething troubles that they just don't know enough. Maybe the MSMEs just don't know enough. So for example, on the retail side, there is, again, I'll come back to UPI because that is what I've studied. But, what we have seen is that, so sort of like going back to the previous question, Sandeep's intuition was right. People have looked at sort of this fintech lending versus traditional banks. And because you have face-to-face interactions with sort of traditional lending, but when you switch to fintechs, there is people who did not get access to credit now get access to credit. There is this, it addresses that sort of bias that might come in on when there is face-to-face lending. And, but what this does not address is there could be some kinds of like statistical discrimination or maybe systemic discrimination where like, maybe certain kinds of potential borrowers don't have access to UPI, maybe by gender or maybe because of some systemic issues like there is these internet black internet black zones that Dr. Niranjan was talking about earlier, and so all of these biases might also translate in when you go into these digital platforms. And I've seen a study by Sehmati which basically talks about how many of on the retail side, again, many of the borrowers were not aware of account aggregators. And also, this was more the less educated and sort of the historically disadvantaged groups. And maybe that is a friction here. Maybe, the potential borrowers do not know enough. But also, my hunch is it might also be something a little bit deeper. It can't be just that.
Okay. Thank you. I would switch gears at this point. I'd move from credit towards wealth. And this is something that this is something so common for us, we actually put it up in our strategy presentations, our presentations at EPR. We generally ask, so there is a dichotomy of the Indian investor today. And that dichotomy is in the following manner. On one side, we do hear, and this is something that Professor Sudarshan also spoke about, that when you trade in financial products without enough knowledge, derivatives in this case, there is a high chance of you losing your capital. 93% of people lose money in a derivatives transaction. If you have intraday equity transactions, and the losses are still, the odds are still 7 out of 10 or 7.5 out of 10. So there is a reasonable chance that if you don't do your homework, there's a high chance that you will lose your money. This is on one side. And on the other side, we also have this, that over the last 5 odd years, and this is something again that came up in Professor Sudarshan's presentation, that nearly 18%, 18.5% of the $5.2 trillion Indian market, fourth largest in the world, today is with Indian households, directly and indirectly, if you combine that. It translates to about $1 trillion of wealth, about 85, 86 lakh crores. And what's interesting is that this 85 lakh crore has increased by about 55 in the last 5 years. So we have something very interesting going on here. Technology has on one side led to droves of Indians coming to the markets. We've seen numbers go from around, roughly 3 crores before the pandemic to 12 crores now in September. They've come to the market, things become easy. We've had digital public infrastructure. We've had economies of scale coming out of, reasonably effective and, affordable handsets, affordable data. All of them have led to, and there is a macro push that, real rates are sort of coming off. So on this side, there's the nudge to come to the markets. And then we have two parts. On one side, you have people losing money in financial transactions. And the other side, there's wealth that's being made on the equities side. What are your thoughts on this? We'll start with Deep.
I'll possibly taking advantage of the august audience and the academic environment. I'd like to say possibly it can start with a correction in the linguistics that we use. And I would say if you have purchased a 100 rupee share and it has become 10,000, you don't have 10,000 rupees of wealth. You have 10,000 rupees of notional wealth. Because, because people who we are trying to advise that don't purchase derivatives, etc., we should also tell them that this is not wealth, this is notional wealth. So that will sort of tempering the bubble to some extent. Other things being, if you are a PhD in economics and finance, would you make better outcome in derivatives trading? It's basically Brownian motion is used in pricing derivatives because it's random, right? So just because you may have a PhD in finance need not mean you will be running better luck than the random Joe who is trading. So there are certain things that narrative need to change, right? Why should people invest in equity on the long term? Yes, of course. Should people have an exposure? Yes. But then we do not often sort of disclose enough on the risk aspects of equity, right? Your investments are subject to market risks. So what does that even mean? It means that Nifty or BSE had for last 20 years, the long-term median average is around 13%. But in 99th percentile, once, it has a negative return of 60%. So you save your whole life's investment, and on the 59th year, you have that year, it can cut down all your investment. So we have to explain what is the risk. Because the popular narrative is that person is so simple that they require the wisdom of a MBA finance like me to invest in their earning. But the market risk they will figure out. It was almost like Arrow's theorem of, a general public, they will be able to optimize all their demands and etc. and price the marginal utility of everything. For everything else, you come to the economy. So I think a lot of this is, I think we have to de-jargonize it. We have to correct the words, because I think, and it started from popular media, that it's wealth, it's wealth. Now, where you invest, and an essential part of financial inclusion that we are missing is not just about credit or having a demat account. It is, we should start teaching finance in a finance management way, maybe right from school, in a very simplistic way on how to manage your money. It goes beyond what is taught in economics, etc. So that's a hygiene factor. I mean, like you teach PT in school for health, you teach basic maths, basic English, you need to teach what is the basic way of maintaining money. And I think it's a long, long journey.
Deep, you are preaching to the converted. Absolutely, absolutely.
No, I think we work together on some of those initiatives, but I think otherwise it's a play of words. I mean, people are the 4/5 of the Indian wealth. No, 4/5 of the notional market cap is with Indian households. That's very, very different and sobering.
Let's ask the technology question then. Exactly, the objective function remains yours, and this is to all three of my panelists. How can we solve Deep's problem? How can we bridge that gap that inevitably crops up? And this comes up in all our discussions. The idea that the average Joe on the street is not a rational utility maximizer who takes full information available and then maximizes utility in an arrow world, arrow debris world. That's not happening. How do you bridge this information gap? And by the way, no easy answers like that what Deep said, teach them in school. There has to be I want a tougher answer, please.
Yeah, I have a contrarian view. I think, the academic literature itself has found that financial literacy is not the answer. So it seems that financial literacy might solve these problems, but it does not. Because basically all these, these digital platforms, these financial intermediaries, they want to play off of those biases of investors. So just teaching people things, it's not going to help.
Prospect theory then.
But let me just give you a little, again, I want to just cite a little bit of research about what we have found in, other contexts. So there is research that, where people have looked at Robinhood. And so there's this interesting paper by Terry Odin and co-authors, where they look at Robinhood, which let me loosely say it's like Zerodha. So Robinhood, they look at Robinhood outages and look at what happens to basically the investors. And so they find that, in the reverse, they basically attribute that Robinhood investors tend to be, these new investors. So it does seem that Robinhood manages to get new investors on board. But these are relatively unsophisticated investors who also basically invest in these attention stocks. So there's a lot of herding behavior. So attention stocks, they have this very neat test where they show that on Robinhood, Robinhood basically will sort of tell you what the top 10 movers are on the stocks. And this is not about the gainers or losers. They'll just tell you the top 10 movers. And they find that the Robinhood investors will actually invest in the losers also. And so there's almost this sort of gamification where, they'll also have like these lottery cards where you scratch the lottery card and then you get like one stock free. So again, the financial intermediary knows what it's doing. It's trying to play off of those biases. And I think it's just not possible to teach people these things and, they will overcome this bias. And more broadly, we are talking about what is happening to the investors. So of course, they are worse off. But there are other implications that we should also think of. The investors are worse off, but there's another paper which uses a very similar kind of empirical strategy by Eaton and co-authors, where they link the entry of these Robinhood investors to stock market quality. So they find that the more these unsophisticated investors through Robinhood, the greater is the stock market volatility. And, again, there are other follow-on effects. Again, because of this herding behavior by these Robinhood investors. And of course, when you look at the more aggregate picture, now this might also have implications for what this means for capital allocation on the firm side. That is, what are the kind of firms that are coming to the market? And so, again, all of this has big, large outsized effects, but I'm not very sure financial literacy is going to fix it. And to me, it seems it's more about regulation. So what SEBI is doing is precisely right. That is, financial literacy is, again, not the easy answer.
Financial literacy, while lacking, while seeding to be increased, but it may not be enough. You would need regulation, which sets me to the next part of our discussion. Guys, how do you see regulation panning out over the next 5-7 years? How do you see this? I mean, and let me just pinpoint this question a little bit. Today you can have an app, very easy to have an app on your phone that allows you to invest, allows you to borrow, allows you to buy insurance, all on the same app. And in a jiffy, of course, before you prepare Maggie. In this world, how do you see regulators going? How do you see cooperation between them? Obviously, your old rules of finance where you had a separate engagement with each one of the regulators according to the asset classes. Those rules are gone. Sandeep, I'll start with you.
So I'll just go back. A few years ago, we started a program. We called it Bharat Inclusion Initiative. And it was essentially focused on how do we bring financial services to some of the most underserved people, the lower middle income kind of segments. The one guiding principle that we had when we were looking to support startups there was, how do you build customer centricity in your product? Right from the design stage. So don't start building a product, go to the customer, talk to them, understand what they're doing. Go where they are. If ultimately they are going to use your app when they are sitting in their store or working in a farm, go there and see whether, what they're even thinking when they'll be using the app, right? So you start with a customer-centric model, and then you start building around it. Personally, I think that this is the approach which is probably the only one that's going to succeed. And I'm still quite hopeful that when regulators are thinking about coming up with any kind of operating models and all, first and foremost, they have that end customer in mind. Yes, they're regulating all the entities, but the primary, stakeholder for whom the regulator must think is that citizen of the country. Right?
No, makes sense, completely. Customer centricity, which is why I can remember in the previous panel, the discussion was on UPI, but there was a question on, can we have gold with UPI? Ribu had to correct that, the idea was that you get the financial leg right, the transaction part right, and let the other ecosystem evolve accordingly. The thought, however, was on customer centricity. Deep, your thoughts?
I think someone needs to define what customer centricity actually is, right? So if I'm able to do a derivative transaction or a ticket size of 5,000 and then close it up in half an hour, and the regulator allows me to do it, is that customer centricity? Because I'm temporarily very happy because the serotonin dopamine cycle has kicked in, right? So I think we need to get what is good. Because so someone needs to define in this context, and that is a larger discussion, what customer centricity is. Now, as a regulator, can I review apps? And there is enough psychological papers, and it goes back to 1960s, when 1950s, 60s, certain types of ads were banned. If I show a hidden image in a movie, say of a FMCG product, you come out of the movie, you will actually go for that product. And these experiments were conducted in 1950, and this type of experimentation was banned. Now we have evolved. If there is a belief at certain corners that certain apps may be actually kicking in the dopamine cycle, then the regulator should actually assess whether that's the case or not, and the app design should be changed. I mean, there is a whole lot of economics which is called nudge, which is basically to topple you to a decision. Now, toppling you to a decision to buy something where I will make money and of course you are my center, is that customer centricity? I do not know. So some type of arbitration would be required, and it goes beyond technology and economics. It's for the society to decide. It's not even a regulator's call. Regulator should present those data and give choices to the society. Is this what you want to be? And if the society at large wants it to be, so be it.
I'm not sure the answer will be so clear, right? Or
No,
the
but,
question
but,
will be so
but
clear.
people should know. Say, for instance, if you know, if I'm buying certain things, I'm buying one chocolate, and they said if you buy 3 more chocolates, which cumulatively is another 1,000 calorie, and it will do wonders for my weight. But they have played around that 15% discount, which is what I will give in, and they pay me now, and is that customer centricity? I do not know. I will love the chocolate, then I will don't know what to do with my extra weight. But I do not know. So should regulators step in? Because the purpose of regulator is not exactly to put granular numbers, rule-based regulation, but the purpose of the regulator where there is technology is evolving, or rather, at a huge pace, it's almost revolutionary technology, not evolutionary technology. There has to be more data transparency, more meaningful research from the regulator itself. And that should go into all aspects, as well as how psychographically these things are working. If you are having a new regulations, or some of these apps, they need to be tested in labs of groups of panels of 1,000 people on how this thing is affecting your mental hormones, and then the call needs to be taken. There is science. If there is science and technology, it is not just for fintechs, it is also for biology, it's also for my mind.
Deep has given his quinquennial view. This is a 5-year sort of target that we must actually try for. I will kind of pause here at this point and probably take 1 or 2 questions from the audience. Ma'am, please.
Good evening, respected panelists. My question to Mr. Sandeep, and probably Deep, sir, you can also give your thoughts on it, because you have given lots of suggestion to the academic institution. And I belong to the academic institution. That's the reason I would definitely like to have the feedback from you. Mr. Sandeep, as you mentioned that I am Ahmedabad Ventures and Bharat Inclusion Initiative and many more you are doing to fund the startup, to make sure that the reaching at the last mile. So have you come across any of the venture who work on the financial inclusion of person with disabilities? Because as we all are aware of that fact that there are, huge potential to contribute on nation's GDP, but still they are facing lots of inaccessibility in the area of digital technologies and not getting into the financial inclusion. So here, Mr. Deep, what you would like to suggest to us as an academic institution to create an intervention strategies to make sure that we train our students, we train our youth to work in this particular area as well. Thank you so much.
Yes, please.
Yeah. So, I mean, this is something that we have given a lot of thought, but let me tell you the biggest challenge, and I'll talk to you as now as an investor. Let's say a VC investor who is looking at a large market, wants the product to scale, make money, and all that. Now, but when you look at, when you paint disabilities with a broad brush, right? There are a variety of disabilities. Okay, you can't just categorize all disabilities as the same. As a result, your product will end up being different. Okay, with the challenge with something like this is that now with different products, it's essentially like you might just end up doing different kinds of. It's just essentially different business, and that scalability, aspect typically does not come in, and that is the reason why we may not have seen as many solutions being developed as we would. That does not mean that we have not come across solutions, because there are. In fact, even recently, there was someone who was looking at enabling UPI payments for people who are blind. And technically, I think even NPCI has come up with a solution that might actually work for them. But question is, again, how do you actually roll it out so that there are no unintended consequences, right? So are there solutions? The answer is yes. I mean, are there enough solutions? Probably no. Maybe there's a different kind of money that needs to come in to build for those people. There are certain generic solutions. For example, you look at solutions that are maybe offering doorstep services, right? These could be agent-led models, but offering doorstep services, they could definitely be beneficial for a few people who are disabled and who maybe lack mobility, right? So there are solutions like that, solutions that cater to not just disabled people, but also other people that can also work for them. So I think those are the models that will probably see success in the market.
Next question. Yes, ma'am.
Hello, everyone. As in the beginning, they said कि rise tide must raise all the ships. Digital technology for financial inclusion. Okay, so the role of new financial intermediaries or technology or regulation, when it plays in informal sector or MSME for cashless transaction, then only we can cater with the financial inclusion part. So what can be the next 5 or digital technology can move all MSME or the informal sector to do the cashless transaction part? How it can be done in that way? So how we can promote it? That is the way.
Dr. Kulkarni? You want to?
I actually have a question for you. Why would you like to do it?
UPI वगैरह all we are talking about that we are spending, but for my financial inclusion for a lower sector, when they are not getting payment in cash, how can do they access all this kind of services?
No, so see, that was exactly my point. I think someone who's not fully financially included, there will be no digital footprint of that person. So that
Yes.
needs to be sort of built up, and there is no easy way for that.
Okay.
There has to be a combination of some awareness building and that therefore the Jan Dhan Yojana, those, government direct benefit transfer, etc., they build a track record, and they are also should be considered as in some early steps of digital financial inclusion, because to digitally include you, I need your digital footprint. If it is not there, I cannot do it.
Okay.
There is no easy answer. So people who are not included, their digital footprint has to be built over a period of time, and some of these things do help in including it. And of course, see, I think one needs to appreciate for a long period of time, we actually had MFI lending, right? We are thinking BNPL came in now, and it's very good. Fintechs came in now, but we had MFI, and there are MFI bureaus. Right, and people use that data. So even within the financial community, there is limited understanding of what all data is available. Okay. So I have people who have only MFI lending, and I have that data in the bureau. I can do something with it. And I appreciate, sometimes there would be people who you would see for better or for worse, the credit is not there, because just because you have digital footprint doesn't mean my model, even if it is very good, will tell you it. I have a model with your digital footprint. So some people need to be high risk. So the high risk will not get the credit. However you look at it, it is not that free for all credit. So when you see someone who's not getting credit in your model, just that doesn't necessarily mean that there's a financial inclusion issue. Because some of the fintechs actually thought that I will use funky variables and create model, and they have some of the highest default rates. So it means that some human being who has gone, checked on the person and decided not to give a credit, the call was right. So it's not a easy, straightforward way. It is a very, very fuzzy thing. It doesn't have a straight answer. It doesn't have a straight solution.
So if I can just take a couple of minutes. So see, when you talk of merchants or businesses in general, there are different kinds of businesses. We have also come across a variety of businesses and a large number of businesses that say we don't want to take credit. Okay, why? Because anyway, we already are getting credit from our suppliers and the like. We don't want to add credit into our lives, right? That said, now we have also seen the other thing happen, especially some of the more, I guess, the nano kind of entrepreneurs also. We have seen that the promise of credit has often been a driver for adoption of digital payments. So you take credit typically with a government scheme, and then, but the government scheme, the amount of credit that you get is typically of a smaller ticket size. But then you say, okay, you've got this, now you start paying back, right? And the way to pay back will be digitally. So you take a QR code, place it, the amount is, getting deducted, and it's getting deducted every day. Let's say you place a QR code, and with that QR code, if you are currently doing maybe 100 transactions in a day, you do only 10 transactions with that QR code, rest you keep in cash. And with that 10 transactions, you get enough money with which you can collect a daily repayment. Now this gets the person started on the digital payment cycle. And then you start building upon it. And once this person is able to fulfill that loan, the person gets a higher credit amount. And thus you start building a behavior, and then you make the change. So again, different strokes for different folks, but there are strategies that you can employ.
See, I think adding to I think credit is always a very, very tricky issue. Most of credit blow-ups are quite often, and credit is a supply-side problem. A supply of credit creates its own demand. And all credit blow-ups are someone who has opened the tap too broadly, right? And while giving credit, I think in a lot of emerging markets, we actually have what is called a probability of default model, PD model, right? Someone who has a small, say, restaurant, they have a PD of 1%. Someone who runs a whole industry have a probability of default of 1%. Now, we do not have a lot of pure debt capacity model in India. We go on the FOIR basis, fixed obligation to income ratio. So two people with same PD, probability of default, same age, same academic degree, same, same office, staying in the same building, their debt capacity may be very different. Now, even if you define a track record that I started with giving you a 3,000 rupees loan and over a 1 year period, I will give you 10,000 rupees loan. What is the implicit assumption? There are two implicit assumptions you are making. You're saying that their hidden debt capacity was actually 10,000 rupees. I am discovering it. Or the implicit assumption is their income has increased 3x in 2 years. We do not bring this out in the open. We have made mistakes, obviously at a small scale, but it's not about getting data, putting into the model and getting a PD and signing off the loan. It's way more, how will you collect the money? I mean, there are norms of collecting. If you have given money to someone who's difficult to collect, your money is as good as given. So, for all you know, some fintechs, a very small portion of them may actually doing the good old loan melas of 90s, but in a digital way.
Makes sense, makes sense. If there are no further questions, are there any? Ma'am, last question to you. Because Ashiana tells me we have to wrap up fairly quickly.
Hello. So basically, I wanted to ask regarding future of credit, whether it lies with the digitization of traditional banking or with the fintech innovations.
Maybe neither, but quick answers. 30-second answer, please. NK?
Not really. I think it's, when we look at, so we have looked at this in the data, and there seems to be a lot of market segmentation. So it can be that, maybe fintechs are just a way for borrowers to build their credit profiles, move on to maybe banks, and so you have a new to bank sort of borrower. And so there might be a little bit of market segmentation where the fintechs again hone their skills in one segment and the banks in something else.
Thank you. Deep also agrees. That's it. All right, that brings us to the end of the second panel here. There were questions and there were answers. Well, if there were questions, there were answers. But I think some of the core points that I sort of took away was it's great. It's great to have technology. It's great to have a world in which technology will solve all your problems. But our panelists told us that if you don't do the basic math, if you don't do your basic homework, then you will be probably giving loan to someone who doesn't deserve it. Having technology will not increase your space in terms of a domain set of lending. People who don't get a loan, they don't get a loan for a reason. It's not easy. Dr. Kulkarni told us that yes, literacy, financial literacy is something important, but there is more to it. There's something more to it. There are human behavioral conditions which go beyond financial literacy in this case. And you know, one of the things that we also came to know was, you know, while things are going good, you have to think of scaling laws as well. You know, you don't know. You're in a world where things have never gone. You've never been in this world earlier, and so we don't really know the consequences as we go into them. So that brings us to the end. Ashiana, all over to you.
Hello. Yeah, I thank you. I thank all the panelists for a very engaging and informative debate. I also thank Dr. Tirthankar Patnaik for summarizing it so well. I now request Dr. Tirthankar Patnaik to felicitate all our panelists. Could we have the mementos, please? I request Professor Mala Lalwani to felicitate the panelists with the MSEPP mementos. I also request the winners of the second quiz to please come near the stage. Could we have the... Now we have the quiz winners. Anish winning for the second time. Congratulations. Akansha and Samir. Could we have their trophies, please? Samir? And Akansha, do we have Akansha here? Okay. Can any of her friends collect the trophy on her behalf? Yeah? Okay. Okay. So we come to the end of this conference. I request Professor Mala Lalwani to give the vote of thanks.
It's an honor and a privilege to propose this vote of thanks for today's program. Pardon me if it's a bit lengthy, but there are so many people to thank that I just cannot let go of this opportunity. So at the NSE, special thanks to MD and CEO, Mr. Ashish Chauhan, Mr. Shailesh Pathak, Senior Policy Advisor, without whom their support, nothing would have been possible today. For the support extended to us at the university, special thanks to our Vice Chancellor, Professor Ravindra Kulkarni. His presence at the conference was very inspiring for us. At the department, a personal thanks to our director, Professor Manisha Karne, who gave me a free hand in the organization of this conference. The two people who helped bring today's event to life, Dr. Tirthankar Patnaik and Dr. Niranjan Rajadhyaksha. They have been from the conceptualization to the finish. When I tried to start writing a few words of thank you, words were short. I just could not do it, so I'm not going to even attempt to thank the two of you. Thank you to Professor Sudarshan, our keynote speaker, whose thought-provoking presentation set the tone for today's conference. The broad sweep of the journey of digitalization set the whole thing going. Our sincere appreciation to all the panelists who shared their expertise, provided us with key insights into the themes covered in the two panels under the discussion. Shri Vibhu Tyagi, Shri Shishir Mankad, Shri Sujay Vasudevan, Shri Deep Narayan Mukherjee, Dr. Nirupama Kulkarni, Shri Sandeep Kojalgi. Thank you to each one of you for bringing to the table various dimensions of the topic under discussion. A big thank you to the mentors of our two sessions who steered the discussion so wonderfully, engaged both the speakers and the audience, and were instrumental in making both sessions so impactful. Large-scale events like this, as we all know, cannot happen without a lot of work which goes on behind the scene. So thank you, a big thank you to the entire team of Economics, Policy and Research team of NSE, Prerna Singhvi, Ashiana Salyan, Prasanjit Pal, Kalyani Birari, Khushi Kumar Singh, and all other members of the EPR team. The minutest of detail have been taken care of in every which way. Thank you to each one of you. Mr. Sushant Here from EPR, he is an alumnus of our department. He formed the sturdy bridge between the university and the National Stock Exchange. Thank you, Sushant, for everything. On the logistics front, at the university, I had this one-man army, Ratish Jadhav, who supported in delivering all the responsibilities that we had taken on. Thank you very much, Ratish. At the NSE, A big thank you to the marketing, corporate communications, admin teams, the volunteers, support staff who ensured that everything ran like clockwork, from stage arrangements to registrations, live streaming, the Slido quiz, which was a big hit, I think, and the catering services, all the logistics worked so beautifully. Finally, the success of every program is judged by its audience. Thank you to all the participants and to all the students from across the colleges, research institutions, and our university departments who are present here in large numbers, who've continued to stay. Thank you for your active engagement. Your enthusiasm rubs off on all of us. As we conclude, let's carry forward the insights that we have got today. We hope that this is only the beginning of all our collaboration with NSE. We hope to be back here soon and have all of you back with us. Thank you so much.
Thank you, Professor Lalwani, and to all our participants and speakers. I request everybody to join us for a high tea near the Round Ticker area. Thank you so much.